we will get from the C-suite of corporate America could be very, very different to the tone of this bond market that we've experienced over the last several weeks.
Radically different. And what's important is the tea leaves we've seen from this selected companies here in the last 2 weeks it looks forward to huge changes, a huge change in tone, I should say, by these corporate officers.
Every single data point, Romain, that you pour over, the ISM, the Guy Johnson and Alex Steele will break at 10 a.m. on any given week. Every single data point speaks to the same theme: scarcity, supply issues, cost pressure, labor pressure. This bond market's going with this transitory theme over at the Federal Reserve, maybe, a segment of it. I wonder what the C-suite's got to say on that debate in the next several weeks, the next month or so.
Yeah, absolutely. And I think this gets to the idea of whether you talk about this as sort of the growth scare, the end of the growth story, or more of this is just growing pains. The idea that this is an economy that's still relatively healthy, but does need to sort of work through some of the supply issues pretty much in every aspect of this economy right now.
We've got to talk about this pandemic as well. We'll do that next with Andrew Pekos of Johns Hopkins Bloomberg School of Public Health, a professor and virologist. And Tom, I'm told that maybe a Pfizer booster shot against the Delta variant is in the making. Is that right?
It's in the mix, and also we're waiting on younger children. Will there be a vaccination below 12 years old? It's really, John, the numbers are fascinating. We're at 55% or more of 12 years and up fully vaccinated.
Wow.
That's a great number.
A lot to discuss. 6:41 Eastern Time from New York City this morning. Good morning. Equity futures up about 15. We advance 1/3%. Yields are higher by 4 basis points to 133.60 on 10s, which means NASDAQ 100 futures are just a little bit lighter, softer, lower this Friday morning. What a week it's been. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. President Biden's team is concerned that time is running out to revive the Iran nuclear deal that Donald Trump abandoned. There have been 6 rounds of negotiations in Vienna, and there's little sign of when a 7th might start. The stalemate is compounded by Iran's technological advances and the election of a new hardline president. And President Biden has defended the U.S. military withdrawal from Afghanistan. The president argued that the U.S. achieved its goals and should not seek to rebuild the country. The Taliban has been making quick gains as American forces pulled out, but the president said it's not inevitable that the Taliban will take over Afghanistan. And a new British study says that most young people face an extremely low risk of illness and death from COVID and have no need to shield from the virus. That backs up clinical reports that children and teens are less likely to be hospitalized or face severe effects. The U.S. is actually one of the few countries offering COVID vaccines to children ages 12 and over. And Bloomberg's learned that Chinese aviation officials are open to conducting test flights on Boeing 737 MAX. That would be a step towards lifting the plane's grounding there after more than 2 years. Even if a test flight is made relatively soon, it could be months before the 737 MAX ban is actually removed. For now, cash is still king at Sotheby's in Hong Kong. A 101-carat diamond was sold for $12.3 million to an unknown buyer using traditional currency, and that disappointed cryptocurrency fans. They hoped the buyer would take Sotheby's up on its offer to accept Bitcoin or Ether. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
went up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Hear me champion travel restrictions as the way to keep a virus from entering a country and to keep it from spreading, because clearly we have many examples where that simply has happened despite travel restrictions.
That was Dr. Jennifer Nuzzo there, the Johns Hopkins Center for Health Security senior scholar from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz is back with us on Monday. Romain Bostic dropping by to help out with some of the price action. Equity futures up 15 on the S&P, 43.28 on the S&P 500. We advance around about 1/3%. Treasuries are lower, yields are higher. Yields have been lower for 8 straight sessions coming into Friday. Right now, Tom Keene, 133.44. We settle down, settle in, north of 130.
Settle down, settle in. Maybe not all the way back, but nevertheless a more constructive bond market with price lower, yield higher. What we're going to do here is dive to the pandemic and then get back to some important Biden headlines that really have to do with all we do here at Bloomberg Surveillance. Andrew Peckhouse with us with Johns Hopkins. We're thrilled he could join us this morning. The mystery for me as someone vaccinated, Professor, is the idea that if I choose to be unvaccinated, how sick is sick when I get the Delta variant? What's the level of sick we should expect?
Well, the data is really rolling in now that the Delta variant is causing disease primarily in unvaccinated populations. And the disease that it's showing seems to be a bit more severe than the disease we saw in similar age groups at the beginning of the pandemic. So if you're unvaccinated, the risk from Delta variant is greater of infection, and there's also going to be a slightly greater increase of severe disease from infection. So there's nothing good about being unvaccinated when you think about the Delta variant.
Where are we on the vaccination process right now? I follow the statistics. I saw something age over 12, fully vaccinated, 50% as well. Are you pleased with the rate of vaccination?
Every vaccination is a good thing. I would love to see these vaccination rates get much higher than they are right now. We've reached a stage where many of the people who are vaccinated now, obviously they're protected from infection, they're protected from severe disease. We haven't reached those levels that really give us a population-based benefit from vaccination yet. That's that herd immunity thing that you hear about all the time. It doesn't mean that the vaccine doesn't work against you individually. The vaccination helps protect you, but at some level, we get that added benefit that the virus is just so difficult to circulate in the population because of vaccination that even the unvaccinated get a benefit from that. We're not close to that level, and as a research scientist, that's what I really like to set as a standard vaccination goal.
Yeah, Doctor, a lot of talk now about sort of what the next step is for those folks who have been fully vaccinated. Pfizer, of course, coming out yesterday and talking about the idea of a booster shot. The CDC saying that, well, maybe not quite yet here. Where do we stand?
Well, all the data so far from the U.S. looks like vaccination, particularly vaccination with the mRNA-based vaccines, is protecting against Delta variant. So I like the fact that Pfizer has gone forward with the clinical trial to show what a booster will do. I think that's important data to have. I don't see it as an imminent thing in terms of a guidance for the U.S. population. But this virus moves quickly. Variants are emerging fast. And I think the Pfizer move is good in terms of preparing for the future. If we get a variant that's even more deadly than Delta, then a booster may be an important thing to consider. And having Pfizer completed the clinical trials for that is going to be a good thing in terms of helping us be prepared for that.
Professor, it's good to hear from you, sir. It's good to catch up. We've got some breaking news we need to run to. Andrew Peckosh there, Johns Hopkins, Bloomberg School of Public Health. A fact sheet from the White House, an executive order on promoting competition in the American economy. And Tom, it's pretty straightforward, the top line at least. For decades, corporation consolidation has been accelerating in over 75% of industries. It's led, they believe, to a reduction in competition, to higher costs, to lower wages, and they've come out with literally, Tom, 72 initiatives, one by one, to tackle some of these issues in the labor market, when it comes to corporate consolidation, when it comes to prices. You name it, it's in there right now.
This is an absolutely extraordinary document, John. I really think even supporters of President Biden will be surprised by the comprehensiveness of this. What this comes down to, John, is the fear of not monopoly, but monopsony, which is there's such a lack of competition that you can set the wage because there's no place else to get a job. And the first line statistic in a lengthy document is consolidation lowers wages by something on the order of 17%.
So what are they trying to change? Here are some of the lines. Make it easier to change jobs and how to raise wages by banning or limiting non-compete agreements and unnecessary cumbersome occupational licensing requirements that impede economic mobility. Tom, you remember the late great Alan Kruger. He used to talk about that often, on how that was holding back wages. So that's just one line in this fact sheet this morning, Romain.
Yeah, and I don't think we can understate really just how broad-based this fact sheet is here. I mean, a lot of people knew that there was going to be a lot more attention paid to some of the big cap tech companies, but this is prescription drug companies. This is banking and consumer finance companies. This is airlines. This is agriculture companies. This is basically every major industry you can think of. The administration is laying out point by point what it says is a level of consolidation that it says is harming not only consumers, but in some cases the workers for these companies as well. And it's making it very clear that it's directing the DOJ, the FTC, and all the other major regulatory bodies that would deal with this type of stuff to target these industries and to target them very specifically.
To enforce the antitrust laws vigorously, and recognizes that the law allows them to challenge prior bad mergers. That one's highlighted, Tom, that past administrations did not previously challenge. Just one by one, to Romain's point. Take your pick. The banks, there's things in there on fees. The airlines, they want refunds from the airlines, make it easier for people to get them back. You just wonder how many teeth this particular executive order has, Tom.
There's people that have written about this, both Republicans and Democrats. I think of Glenn Hubbard and Paul Krugman as being two polar extremes in politics who come to the same conclusion on this. John, the way to look at monopsony and the ability to bargain fairly for wages, the classic text, and this is particularly off the desk of the London School of Economics, is think of a rubber plantation in Malaysia, or a rubber plantation in Singapore. When you're out there in the getting the rubber, getting the material, who bargains for that wage? Is it the plantation owner, or is it the people collecting the rubber? And the answer is that plantation owner has a lot of power.
Yeah.
What this document says is airlines have a lot of power. Hospitals have a lot of power, et cetera, et cetera.
And he goes through it one by one, one by one. And coming up in the next hour, what we're going to do, we'll head down to Washington, D.C. We'll catch up with Anne-Marie Horder down in Washington, and we'll get you up to speed on what's going on with this live on TV and radio. To wrap things up on this program in this hour, let's run through the price action for you. Equity futures on the S&P drifting higher by 14. We're higher by a third of 1% to 43.27. Advancing there in the equity market as your Treasury market heads the other way. Treasuries lower, yields are higher by 4 or 5 basis points to 133.95. The White House releasing a fact sheet, an executive order on promoting competition in the American economy. Full coverage coming up on TV and radio next. From New York, this is Bloomberg.
delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Some type of a pullback here just seems natural and normal, and this is not the reason to exit the market.
It's inevitable that the boost from reopening and from fiscal stimulus will fade.
You will get periods of setbacks in equity markets because, that's simply what they do.
We have to take the move in the market seriously.
The market likes higher rates, and people just don't want to buy into that idea.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Can we just have one quiet morning from New York City for our audience worldwide? Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Lisa Abramowitz will be back with us on Monday.
So she says.
Together with Romain Bostic this morning. Equity futures up 15 on the S&P, 43.28. And it's the fact sheet, a readout from the White House that gets your attention, TK. An executive order on promoting competition in the American economy.
Well, they want to promote competition, but I'm going to get right to this, John. There is a magical thing in Western Massachusetts every weekend. It is the Great Barrington Farmers Market. And buried in that 72-point executive order is a complaint of the administration over fair pricing and boosting farmers markets. John, you got to be kidding me. President Biden is going to somehow adjust the Great Barrington Farmers Market?
I've got no idea if that's achievable, Tom. The broad strokes of this particular readout, though, are pretty clear.
Yes.
They don't like the broad consolidation that's taken place in this economy. Over 70% plus of industries of the U.S. economy, and they worry that it's been pushing down wages and pushing up prices, and they want to do something about it.
John, I'm going to do a major shout out right now to Catherine Mann of the academics of MIT and, of course, at Citigroup, and now vetted by the Bank of England for public service there. Dr. Mann, on the desk of surveillance at least 3 years ago, gave out a primal scream over the consolidation of American enterprise. She was right then, then, she's right now.
These are the broad strokes of this readout this morning. Romain, I know that you'll be focused on the sector-to-sector story.
Absolutely.
The fast food chains, the non-compete agreements. Then you've got the airlines, then you've got the banks. Take your pick.
Yeah, take your pick. And there's a lot of minutia in here, but it's important because this minutia is actually enforceable by the Biden administration without Congress getting involved. And I think that's why investors really do need to take some of these things seriously here. Also, I think some of the language in here about unionization, about right to work, about the idea of mobility with regards to state licensing requirements. These are huge issues that this administration can bypass Congress to get done. And that's something that you have to be concerned about if you're in certain industries.
In this readout, Romain, it talks about the regulatory bodies looking at past mergers that have already happened that maybe previous administrations didn't take a close enough look at. What do you think they might be talking about here?
Oh, what they're talking about Google, they're talking about Amazon, they're talking about Facebook. We've heard from Elizabeth Warren and a lot of the progressives on Capitol Hill. They've been pushing this idea now long before Biden got into office. The idea here that he's on board with this means that some of those deals are going to be scrutinized. You talk about Facebook, WhatsApp, you talk about some of the Amazon deals of smaller competitors that probably weren't a threat at that time, but were on their way to becoming a threat that were effectively neutralized. And look back at those could have huge implications going forward for how these companies grow.
These are things that could take a long time to sort out. Elsewhere in this particular readout, Tom, there are things that can be done pretty quickly too.
Well, they are. It's an executive order. That's the difference. I guess it's an end around Senate, end around House as well. And, you know, John, with our esteemed guest coming up here in moments, it's just real simple. When does this go into effect?
We'll head to Washington in just a moment. Here's the price action. 43.29 on the S&P. We advanced 16 points, up 0.4%. Yields are higher. Treasuries are lower. 144.11, up by about 4 or 5 basis points. Euro dollar, euro stronger. Euro dollar positive, a little more than 0.1%. Euro dollar 118.59. Let's head down to DC and catch up with Emily Wilkins, our Bloomberg government reporter. Emily, you've had a read. What's your take?
So this is a really wide-ranging executive order. There are like 72 different provisions in here, everything from airline luggage to big tech to drug prices. And a lot of this stuff, you know, as we talk about this reconciliation package that is coming down the line and that Republicans are currently putting together in back rooms, trying to put pen to paper on, we have to acknowledge that the reconciliation process that we're talking about Congress going through is very limited. I mean, this is a process that really deals with the budget, with spending, and with how the government spends money and controls the debt and the deficit. And so these regulations out this morning from the Biden administration really cover a lot of areas that Congress would not be able to touch through a reconciliation process, but deal with those overarching themes of competitiveness, of trying to make the economy a little bit more even for consumers.
Emily, why the kitchen sink approach? I mean, it seems like they've dumped everything into one document. Does that surprise you and Biden watchers?
I don't think at the pace that we've seen President Biden go with these executive orders. I mean, remember the first 2 weeks of the administration, it was every day a brand new executive order, a brand new complex issue. Biden has been around DC for decades. He very much knows government and structure. He's very aware of what they want to do. And he has a White House that is staffed with aides who are also very well aware of these things. So I think by putting all of this into one package, instead of doing a small thing here and a small thing there, they're coming out with a comprehensive message, a message that they want to try to make businesses more competitive. They want to make things more equitable for consumers, and they want to target these variety of areas. Taken alone, any one provision is pretty small. Taken together, they send a much wider message about what the administration wants to do.
John, page 6, paragraph 3, there will not be a gouge for the England-Italy football game.
Oh, thank you, Tom. I'm pleased you looked into that. I mean, it does cover everything. And Emily, to Tom's point, sometimes with these kind of executive orders, it's about the optics and not the substance. What would your read on that be right now?
To a certain extent, executive orders, they're great because it's the president just acting alone, and then they're not so great because the next president can just come in and undo everything you did with a stroke of a pen. So this doesn't really have the long-term stability that you might get through a law. At the same point, you read through this list that the White House put put out this morning, and a lot of it has words like encourage or ask agencies to look into or have them go into. It doesn't actually have a lot of very clear and direct, this must be done, that must be done. It's more of having agencies, giving them instruction and guidance.
But Emily, we could certainly divine from some of the people that he has leading these agencies what direction this might go, particularly at DOJ, particularly at the FTC with Lena Khan. I am curious, there's a broader question here about presidential administrations taking this route, trying to do this end round around Congress, primarily because Congress is basically stasis embodied right there. You've seen this with the Biden administration. You saw this with the Trump administration. You saw this with the Obama administration. Is there sort of any sense that we ever get back around to this idea that the checks and balances that Congress is supposed to represent, that does become a factor in how these types of rules, major overhauls of U.S. industries and how these industries are regulated, Congress has a say?
I mean, right now, if you look at Congress, look at the tech antitrust legislation that they're trying to pass. This is something that has bipartisan support. You have both parties saying that something needs to be done. And yet you had a mostly partisan bill wind up passing through committee. And now Democratic leaders are saying they can't even bring it to the floor for a vote because California Democrats have some concerns with the overarching bill. And so even on something that has as much agreement about antitrust in big tech, you are seeing Congress really get stuck in the details here. And it's not even necessarily a partisan thing.
I mean, to me, it's an end around politics, whether the president's Trump or Biden. I'll let somebody else decide that for me. Emily, I'm looking at grass-fed beef. I mean, you know, the fact is, I'm going to go out to Ben's Chili Bowl up on U Street in Washington this weekend, and I know they're going to use grass-fed beef, and it's American-made, except this document says much of it is not. So they're going to micro-tune the Department of Agriculture to what? Pull it back from Trump things or to make new law, new initiatives?
I mean, a lot of this is a reversal of what we saw with the Trump administration. I mean, we see that from the FCC's net neutrality rule that Biden's now asking them to look into, to some just regulatory things in general, Tom, as you just mentioned. And please enjoy a chili dog for me while you're there.
Yes.
But a lot of this is, it is a reversal from the Trump administration. And it is to a certain extent, once again, Biden's going to be able to do this very quickly. He's able to send out a message, but at the same point, the fact that he's doing this via an executive order means that it's going to be very easy for the next president, if they're a Republican, to quickly undo a number of these things. Emily
Wilkins, down in D.C. It's good to catch up. Emily, thank you. For anyone that thinks Tom goes off on a tangent and you don't know where he's going, and I know some people wonder whether we actually get on. We do. I remember going for lunch with a former central banker. I won't name the central banker. And we talked about Tom's interview style with central bankers. And he said, here's the thing, John. When he mentions these random studies and these random things, they're real. And they are actually appropriate for the conversation we're having. And when Tom mentions beef, the first thing I would do is just go to the particular statement from the White House this morning and search for the word beef. And here we go. So let me add some meat to the bones of what you're talking about, Tom.
Cute.
4 large meatpacking companies dominate over 80% of the beef market, and over the last 5 years, farmers' share of the price of beef has dropped by more than a quarter, from 51.5% to 37.3%, while the price of beef has risen. Tom, that's just a little example of the things they're trying to get at in this economy.
It's a stunning document, I really have to say. It is a compendium, John, of what maybe under President Trump would have been 15 executive orders, all in one, all laid out with immense precision. And as you say, John, paragraph to paragraph, immense anecdote.
That is just one anecdote, but the broader story is clear. That leads to that one anecdote, remain as consolidation, and they're not a big fan of it.
Not a big fan of it at all. They basically make the case here that it has had not only harmed consumers, but you see in this document, he talks a lot about how it's potentially harmed workers. The idea of people being able to switch jobs and facing non-compete agreements or facing issues with the mobility of their licenses from one state to the next. The idea of more right to organize rules. It'll be interesting to see whether what the follow-through is here, and more importantly, what kind of pushback you get. A little bit harder to lobby regulation versus legislation, but I'm sure some of these industries are going to push back and push back hard.
John, are they going to legislate Amazon Prime?
It's over.
You know,
it's over. Like the growth scare remain from this morning as well. Look, TK, we have to talk about the labour market and all of this as well. I mentioned the late great Alan Kruger.
Yeah, yes.
Danny Blanchflower of Dartmouth has done some great work on this as well. I understand from our producers that Danny can join us in about 20 minutes' time, so that would be absolutely...
They didn't tell me that.
Fantastic. I usually get first word on these things, Tom.
Really, you do?
Coming up in the next hour, 8 a.m. Eastern Time, David Riley of Blue Bay Asset Management from New York City this morning. Good morning. Really interesting morning. 43.29 on the S&P, advancing 16 or 17 points, up 0.4%. Outside of that, Treasury's lower yields higher by about 5 basis points to 134.11. Heard on radio, seen on TV. Alongside Tom Keane, I'm Jonathan Ferro. Together this morning with Romain Bostic. Lisa Brambis back with us on Monday. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden is signing a wide-ranging executive order today aimed at promoting competition in the economy. Amongst other things, it calls for supporting programs that would import cheaper prescription drugs from Canada, save consumers money on their internet bills, and make it easier for people to get refunds from airlines. The president also seeks greater scrutiny of mergers in the tech industry. And the Biden administration will reportedly add at least 10 Chinese entities to its economic blacklist. That's according to Reuters, and that could happen today. The move has to do with China's alleged human rights abuses and high-tech surveillance in Xinjiang, the homeland of Muslim ethnic Uyghurs. China's pushed back strongly against the criticism. It says the U.S. and its allies are bullies. And Pfizer plans to request U.S. emergency authorization for a third booster dose of its COVID vaccine. That's after data showed it can sharply increase immune protection against the coronavirus. Still, federal health officials signal that they would take a cautious approach to potential booster shots. And a new twist in the assassination of Haiti's president. Colombia says retired members of its army are suspected of having taken part in the killing. Haitian police said 28 people carried out the attack against the president. 26 of them are said to be Colombian. The other 2 were described as U.S. citizens of Haitian descent. 4 alleged assassins have been killed and 6 others arrested. And billionaire Richard Branson has made his reputation with a series of daredevil exploits. He returns to that on Sunday when the 70-year-old is scheduled to take a rocket-powered trip to the edge of space. A test flight of Branson's Virgin Galactic craft would be a step towards carrying ticket-buying passengers. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Rishka Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Let's be very clear. For France, we aim at having more than 15% for the minimum taxation. I think that we need to be ambitious. This is the unique opportunity that we have to have a fairer, more efficient international taxation system for the 21st century.
It is fair to say that Maria Tadeo did not get the short straw. Maria Tadeo with Bruno Le Maire, the French finance minister, speaking at the G20 Finance Ministers Conference. Where are they, Tom?
They're on the east side of Venice at Arsenal, which is incredibly historic, and to visit is jaw-dropping. It's where, John, they built all the stuff to battle the Genoese over in Western Italy, out in the Adriatic, and then over to Turkey.
And you're very unhappy that you're not there, I'm sure.
And even worse, I'm told Francine Lacroix is leaving today to follow up with him.
Oh, really?
Leaders. John, I mean,
that's not a
for
shock.
starters, Pharaoh, Italian.
I know.
Like, if anybody should go, it should be you and Francine.
Tom, you and I could have gone. We could have watched the game on Sunday.
You know,
could have done a little
hung out
thing
at the bar
on
of
the recovery of the Italian economy.
I mean, the Metropole's halfway to Arsenal from the fancy hotels, and the Metropole's where I stay.
Tom Keane, Jonathan Ferro, alongside this morning, Romain Bostic, Lisa Abramovich back with us on Monday. Sometimes we do this, Romain. I think he's familiar already. S&P 500 futures up almost 18 points on the S&P, 43.31. Let's call it 43.31 on the S&P 500. We advanced 0.4%. Tom, yields are higher by 4 or 5 basis points. Your yield on a 10-year this morning, 134.11.
Yeah, it's come back. I mean, it's just a better tape. That's all there is to it. Just plain and simple.
NASDAQ basically unchanged. There you go. NASDAQ 100 futures unchanged on the day now, too.
We need to get ready for next week. We're going to do that with James Paulson. Jim Paulson with Luthold Group, their chief investment strategist. A quick visit here. Jim, how important is this earnings season?
I think it's going to be important, Tom. I mean, you know, this market's facing a lot of negative things right now. Everything from being up almost 100% off its March 2020 lows. That's one of the biggest 15-month advances in the stock market ever in post-war history. You know, you got COVID variant up, scaring people. You got inflation surging here. You got Fed talking tapering. You got the M2 money supply contracting. You got the stock market wondering what the bond market knows that stock investors don't. So there's a lot of negative pressure. And one of the things that could alleviate that would be another earnings season, which is going to probably be phenomenal again. And what is really going to be important, I think, is not even so much the raw numbers, although they'll help, will be if some of the CEOs still have confident outlooks for the future. I think they'll take the sting out of some of this and maybe start re-rallying the stock market again.
Jim, can we just get into that Wall Street cliche that you just used tongue-in-cheek just a moment ago? This idea that there's this room of bond investors doing their own thing, and they don't talk to the stocks investors, and the equity investors sit in another room and they look over and say, what do they know that we don't? Do we really think that way when we see a move in the bond market, that someone knows something we don't?
Well, I think we've kind of come to get used to that, because certainly the bond market's got a heck of a good record, Jonathan. I've been burned by it in the past, where the bond market's doing something and stocks aren't, and the bond market ends up being right. So it does gather your attention. I think there's, you know, special factors today with quantitative easing being such a heavy influence in bond yields. But I got to tell you, you know, I look back historically, and we've got an interesting situation going on here where yields have been falling in the last, long-term yields have been falling in the last several months. And yet, when you think forward over the next 6 months, almost everything fundamental is going to go up. Yeah. Real GDP, jobs, incomes, profits, and almost everyone thinks that, and it's probably correct. Not only will it go up, it'll go up strongly. And when you have this combination historically, going back to 1950, of falling yields for several months, followed by fundamental improvements, that's been really good for stocks. In fact, since 1990, the stock return in the next 6 months after a falling yield period like this has been nearly double the return of all the rest of the time. So I'm not as concerned. I think before the stock market really finally gives way, we're going to have to see higher yields. I'd be much more concerned if the bond market's at 2%, worrying about inflation, than I am about at 130 worried about weak growth, because I don't think we got weak growth coming.
All right, so a lot of cues we can take here, Jim, from what's going on in the bond market for equity investors. I'm curious, how much attention do you have at all right now on what's been happening with the dollar here? That seemed to be the call a lot of people were making. I don't know, I felt like 8-9 months ago, sort of watch the dollar, watch the dollar. I'm not sure what the dollar has really told us just yet.
Well, I think, Romaine, that the dollar has got a very similar message to the bond market. The dollar rally that we've seen, which has been fairly significant, occurred almost coincidentally with the drop in bond yields. And I think they're both saying the same thing. There's a bit of a fear premium here. The rush to the dollar, I think, is rush to safety, if you will, which kind of reflects the same thing going on in the bond market. I don't know if they're right, but they seem to have a very consistent message. And of course, the dollar rising certainly hurts the cyclical sectors, it hurts international stocks, it hurts small caps more. And I think that it helps people return to growth stocks. It's been part and parcel of the shift in leadership that we've seen as well. I personally think the dollar is going to come back down here in the rest of this year, and yields are going to go back up.
Jim, I'll give you a choice. NASDAQ 100 for the rest of this year, or SPX, the S&P. What do you hold? Which one? NASDAQ 100 or S&P? Or the Russell if you want. You can have the Russell if you want to. There's 3 choices there, Jim.
I like the Russell. That's the one I'd go with. I'd go small cap stocks.
I had a feeling you might. That's why I gave you the option. Stocks. I'm feeling nice, Jim. It's going to catch up. Jim Paulson, the Leuthold Group Chief Investment Strategist. Just that simple question gives you an idea, Tom, of where people still stand on the equity market and which part of the equity market they like. The small caps for Jim Paulson.
And to me, John, it masks the big issue, which is you've got to be in the market. Take Gina Martin Adams of Bloomberg Intelligence with the mantra, look, you've got to be in the market. How many people, John, aren't in this market?
And that's the problem. And how many people are worrying about being active when being passive year to date remain?
Yeah.
You've done okay in the NASDAQ and the S&P and the equal weight, the Russell. Take your pick.
Yeah, and I mean, you look at this morning, you look at futures this morning, it is Russell futures out front of pretty much everything else. And there was a lot of people saying that people were too quick to turn their back on some of the cyclical names, some of those small cap names, and maybe that was a little bit too premature. Maybe that bid comes back in, maybe it's sustained, maybe that brings us back up to the levels that we were just at, I guess, well, a week ago.
The bond market in the driving seat, yields set the tone, and yields this morning are higher, so take that and guess what's happening elsewhere, and you'll probably be right. Another thing we've got to do in the next 30 minutes of this particular hour is get up to speed on that executive order from this White House, Tom, and I mentioned a little bit earlier we would catch up with a labour market expert, one of the best worldwide, and we will do that with Danny Blanchflower at Dartmouth next on this program.
His book, The Wage Curve, was definitive when it was published, and what's so cool about Professor Blanchflower, John, is he has continued his research. He has been extremely productive in the last 24 months.
Danny Blanchflower of Dartmouth joining us on this program next on radio, on TV, alongside Tom Keene. I'm Jonathan Ferro. Together this morning with Romaine Bostick. Your equity market, 43.30 on the S&P, advancing 18 points. We advanced 0.4%. Bonds set the tone. What does the bond market know that you don't this morning? Yields are higher by 5 basis points, 133.94. From New York, this is Bloomberg.
we're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City for our audience worldwide on TV and radio. Good morning to you. This Friday morning, here's the price action. S&P 500 futures doing okay, approaching 43.30. We advance about 0.4%. Nasdaq unchanged, totally flat at the moment. Your clue, it comes from the bond market, as you might expect. Off the back of these moves, we've seen 8 straight days coming into Friday of yields lower, and banks have been hurting. The banks from the June highs down about 11% on the S&P 500 banks. Can they get just a little bit of reward from this bond market now with yields up and a curve a bit steeper? 133.77 on 10s, on 30s, 197.18. We advanced there about 4 or 5 basis points. Still sub 2% no. Want to look at the curve. Here we go. This is 5s, 30s. And I want to acknowledge where some of the thinking that I'm going to at least explain to you right now is coming from. Ed Bradford out on Twitter with a wonderful chart of 530s. And it's the second peak that you'll see in the year of 2021 that is fascinating. That second peak came on May 13th. May 13th for the peak in the yield curve. May 13th. Now, that's important, Tom, because that was a single day after the April CPI report. That steepness in the curve, and since we got that, this curve's rolled over. It's been flatter. So really, when you start talking about peak everything, it's peak inflation fears that are important here. And when it comes to the curve, something else, some work that our colleagues Liz McCormick and Elizabeth Stanton did on Bloomberg News in the last 24 hours. Take a look at their piece about the yield curve and what some of the people on Wall Street are saying about it. So here's the stat for you, Tom. Citi did the work. They looked back pre-2008 when the yield curve peaked, on average, 12 months before the first rate hike. So just think about it for a moment. Have we already seen the peak of the yield curve in America, which is kind of difficult to get your head around because this cycle is moving so quickly?
I agree. To get your head around it in July is really difficult. I think John will have so much more clarity after earnings season and after some of the hard data comes in onto the not only the next Fed meeting, but the next 2 or 3 Fed meetings as well.
This chart right here, 5s, 10s, but 530s. Says the same thing. So take a look on your Bloomberg terminal. Let's get you some movers. Here's Romain.
Yeah, John, let's start off here, of course, with the Biden administration set to sign this executive order, pretty sweeping executive order seeking to target competition out there across a wide variety of industries. The market reaction so far, though, has been relatively muted. You can see Facebook down about 0.2%. Comcast, which, of course, would be affected by some of the net neutrality rules that the Biden administration is seeking to revive. Those shares only down about 0.2%. And the railroads actually slightly higher higher, though we should point out the railroads actually had sold off yesterday because of concern about this executive order, which of course is also going to target some of the shipping costs as well. It'll be interesting to see how much saber rattling the Biden administration does, but more importantly, how much follow through there is, because we've been here before, even with previous administrations, concerned about consolidation, concerned about competition, but ultimately not a whole lot came out of it. You flip up the board, the other big story here that we're going to be talking about, particularly heading into next week, of course, is the start of the earnings season. The big banks, of course, kicked that off, including Bank of America, Wells Fargo, JP Morgan, and the like. Those stocks getting a little bit of a bid today. That might partly be because of what we're seeing in the yield space, but also relatively high expectations here going into that earnings season. And keep an eye on GM. Dan Ives out with an interesting note this morning. Of course, he's been relatively bullish on Tesla for a while and its EV strategy. Now he's bullish on GM and its EV strategy, initiating coverage there, really saying that GM now, one of those companies that not only is is managing to catch up with Tesla, but more importantly has the potential, guys, to actually get out in front of it.
Romain, thank you so much. From the advent of Bloomberg on the economy and Bloomberg surveillance, what we've tried to do is go to the experts. That's been the demand of all of our audiences, and particularly global Wall Street. David Blanchflower, a few decades ago, definitively restructured our labor thinking with his book, The Wage Curve. And what we all know is our wage curve as a society has been shattered in the recent decades. He is at Dartmouth College. David Blanchflower joins us this morning. Danny, I look at where we are, and you're the first name that I came up with. And what I want to talk about more than anything is the primal scream nature of the 72-point executives order. Who is screaming about consolidation in America?
Well, I guess the way you would think of it now is that workers have been hurting. Non-workers have been hurting. They've been hit by a serious pandemic, and it's had a big impact on the world. But this sits on the end of many decades of poor wage growth, and the balance of power between workers and firms has shifted quite considerably compared to where it was. So this is a sort of, I read it, and I've read it very quickly in the last 20 minutes.
Sure.
This is a kind of primal scream to try and redress the balance of power between workers and firms. Now, I think the commentary we just had is important. Market response is very little, because the question is, does it have any teeth? Is it merely wishful thinking? Well, so I read it that this is trying to think about some of the stories about big firms, about Google, about Facebook, and so on. But this is a scream in a sense. But David, start to think about that balance being checked. Whether it can do that is unclear.
What is so important to me, Professor, is the idea from you or liberals like Paul Krugman or conservatives as well. The late Ed Lazier out at Stanford is the overwhelming theme of that document is technology is here and we are using and adapting to technology every day. Within the economics of monopsony, can we take the deadweight loss of technology and can we put the genie back in the bottle?
Well, probably not. I mean, the teeth is the big story, but I do think that in some sense that I like to think of it this way: firms have the ability to pay higher wages. They've seen no real need to do that, and they haven't shared those wages. And those, in a sense, the profits that they've made. So this is a scream to try and do something about that. I mean, look at real wages. I mean, I've written about it for 30 years. Still, even with the growth that we've seen, real wages today are still below what they were in the 1970s. So this is about trying to think about that coming out of the White House, coming out of C.C. Rouse, who cares about these kinds of questions. The issue is, can you change this balance? There appear to be sensible things there in terms of, let's think about this occupational licensing. Let's think about ways in which we can get prices down. But in a sense, Anno Domini just continues. And in a sense, I read it as, we would like for these things to happen. We would like to try and sort of stop the world from rolling. Yeah. But there's little or nothing in it. I mean, there is going to be a White House Competition Council, but that's true. But
Danny, let's talk about that word. And forgive me for jumping in, because I think that word is so important. The knee-jerk reaction from conservatives this morning, I think, would be to say, I'm from the government and I'm here to help. run.
Right.
This is a problem. The government wants to set prices, all those kind of things. But I hear competition and the lack thereof. And Tom, I think, rightly mentioned the late, great Alan Kruger and some of the work he did on non-compete clauses and the labor market. And this is about trying to reintroduce competition where there hasn't been enough competition. Can you just sit there? That's your world, the labor market. Something like non-competes and a problem that has caused.
Well, this is about the balance of power. When the balance of power sits with firms, firms can put in occupational licenses, and they differ by state. And in the UK, they can do these things called zero-hour contracts. That's what happens when the bargaining power shifts strongly towards firms. If you can somehow or other redress that, take the occupational licenses away, that increases the powers of workers. That's what this document is about. But the first thing you read it, John, is it doesn't have any teeth. It doesn't have, how are we going to do this? Yeah, you can say, you know, it would be a good idea to lower drug prices. It would be a good idea to let people have refunds. And in some sense, what we'll see, and it's something I've argued about a lot, workers' ability to bargain these things becomes greater as the economy moves towards full employment. And so we're seeing these adjustments going on. And in the last 6 or 7 months, we see increasing power of workers trying to get, you know, trying to deal with the bottlenecks that we see. So I think this is a sort of an opening salvo.
Yeah.
Alan Kruger's work is really important in that area. Firms can impose rules when their bargaining position is strong. We will see what happens. Yeah. But I just think, you know, this is an opening salvo, it seems to me.
But Professor, when we talk about some of the market forces that have sort of pushed a little bit more, given the workers a little bit more bargaining power here, the idea here that the administration now wants to nudge that even further, not necessarily a surprise, but the idea when you start talking about some of these right-to-work issues and some of these licensing issues here, this is now a major shift, if he's able to get it through and able to sort of enforce these things. This would be a major shift in the U.S. economy, in the U.S. labor market.
I think it would be, and there are signs around the world that this shift is underway. 2 examples. In the UK, we've seen rising unionization rates, and actually in the United States, in the last data that we have, union density rates, that's the proportion of workers in union, has actually risen. Why is that? It's because actually in the last years or so, non-union jobs have actually declined. So I think there is some evidence in the last couple of years that there is a move away. I mean, the right to work laws are laws that can be imposed when there's plenty of workers around. So I think you're right. The balance between workers and firms seems to be changing a bit. I mean, this is a really important and interesting document. It suggests that, you know, we're going to see a push on the front of let's increase the power of workers. But whether you can impose that is another thing.
The problem is, Danny, that's the left-wing interpretation of this. And I mentioned a little bit earlier what the conservative criticism would be. We're trying to reduce the friction of corporations. Yes. At the same time, I don't want to introduce more friction on the labor side with unions. And you know that's a political point.
Of course I know that's a political point. That's true. I'm just suggesting that there are trends that are moving, partly because that's what's happening out there in the world. Yeah. I mean, we've seen those things happening. But yeah, John, I mean, I don't think it's the left-wing view. I think it's that the reality is where we are. How that's going to change will really depend upon how tight the labour market is.
Yeah, and we can both agree we need more competition. Danny, you and I could talk forever. I'll give you a call later. We'll carry this on and a little bit more. Danny Blanchflower of Dartmouth College. Thank you, sir. Alongside Tom Keane, I'm Jonathan Ferro. Together this morning with Romain Bostic. Lisa Abramowitz will be back with us on Monday. Equity futures 43.30 on the S&P, advancing 0.4%. Yields are higher by 5 basis points to 134.44. I think we can all agree we need a bit more competition. It's just how you achieve it. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden's team is concerned that time is running out to revive the Iran nuclear deal that Donald Trump abandoned. There have been 6 rounds of negotiations in Vienna, and there's little sign of when a 7th might start. The stalemate is compounded by Iran's technological advances and the election of a new hardline president. A new British study says that most young people face an extremely low risk of illness and death from COVID and have no need to shield from the virus. That backs up clinical reports that children and teens are less likely to be hospitalized or face severe effects. The US is actually one of the few countries that offer the COVID vaccines to children ages 12 and over. European finance chiefs are trying to reassure their group of 20 counterparts that the region will unite behind that global corporate tax deal. Bloomberg spoke to Spain's economy minister in Venice.
I'm quite confident. I think that a lot of work has been put into these negotiations. There was a major breakthrough with the new administration on the other side of the Atlantic, obviously. And I'm confident that we will have a deal that sets the basis, for the appropriate legislation throughout the world.
Calvino is also confident there will be a deal on the taxation of digital giants. The US wants existing taxes on those companies removed. China is trying to make it easier for banks to go lend to smaller businesses. The central bank has cut the amount of cash that it must hold in reserve. The People's Bank of China cut that reserve ratio by 0.5 percentage point for most banks. That should free up about $154 billion into the economy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg surveillance. Weekday mornings on Bloomberg Television and Radio.
The Governing Council considers that price stability is best maintained by aiming for a 2% inflation target over the medium term. The new formulation removes any possible ambiguity and resolutely conveys that 2% is not a ceiling.
That was President Christine Lagarde of the ECB. This whole strategic review, I think, tells you so much about Europe, Tom. All that effort, all that time dedicated to making the smallest of possibly inconsequential moves at the European Central Bank.
Folks, I'm worried more about Italy, England. I didn't see that video until just now. John, you've got to be kidding me.
What do you want me to say? I think the bond market heard what you heard, Tom, which was not a lot from the ECB.
Wow.
Do you think that's Christine Lagarde, the ECB president, or do you think that's just the natural consequence of the construct of the European Central Bank and the Bundesbank's role in all of this as we go on?
Look, I have a hallway, John. My eyes are so bad I don't read books anymore, but I got a hallway left of economic textbooks I've collected over the years. None of what we're living is in one single of those books. They're all making it up as they go. Somebody who makes it up, and we read each and every day, is Ian Lingen, BMO Capital Markets. He writes a brilliant morning note giving guidance on price and yield. We're thrilled he could join us in this tumult today. Futures up 22 right now and yields higher. Ian, what are you writing today so I can think about it over the weekend to act on Monday? What is the specific thing for this weekend?
So for this weekend, Tom, I think that the primary focus should be preparing for next week's accelerated auction schedule, as well as CPI on Tuesday. What we have is, because of the settlement issues, we're going to have a 10-year reopening on a Monday. It's very, very rare. And I suspect that that's what's going to drive price action in the very near term. So we've been on board with the rally back to 125, but from here, a period of consolidation makes sense as the market comes to grips with the reality that this is a big repricing that has taken away from the reflationary notion.
There is, in the equity market, Ian, I think you're aware there are stocks out there that you can go long and short on. There's BTFD. How about BTDD, buy the disinflation dip? Are we seeing bond people come in here with the yield movement and act?
For sure. I think what we're seeing is people looking at a Fed that we thought would be less responsive to inflation, not dissimilar from what the ECB is now signaling, to a Fed that's they'll step up if needed. And I think that that's where we have seen a flattening emerge. And that does suggest that any type of near-term inflation that we see, if it isn't transitory, the Fed will get involved. And if the Fed gets involved, that is, by definition, the anti-reflationary trade.
You mentioned the supply next week, 3s and 10s, 30s as well. Get a lot of supply from the Treasury next week. You've made the point, though, Ian, you mentioned CPI out on Tuesday. You've made the point repeatedly that you should ignore the data. Do you think you can still ignore the economic data?
I think that we should be ignoring the traditional reaction function to the data. So said differently, higher inflation, we might want to sell treasuries. I would say buy them.
Wow, interesting. Carry on. Carry on, Ian.
The notion is anything that brings the Fed's liftoff rate hike closer is going to be bad for 2s, 3s, and 5s. But because of the flattening dynamic that has emerged, it's going to be good for 10s and 30s. So a bit counterintuitive response, but I think that that is what the market has been telling us over the course of the last 2 weeks.
Ian, that is not early cycle behavior, is it? That's what you'd expect towards the end of a cycle, am I right?
Exactly. And I think that that's the same argument as we might be experiencing a bit of a policy error on the side of the Fed. That's not our stance, but that narrative is out there as well. And that's just the idea that the Fed's taking the excessive monetary policy accommodation away a little too quickly. This makes sense given what we're seeing from the global recovery perspective, as well as the risks associated with the Delta variant.
So when we start talking about some of the spreads and the narrowing that we've seen, where's the equilibrium that you're looking for right now, Ian?
So at this moment, I still think that there's a chance 10-year yields can make it to 121, 122, but that will represent the local bottom of the yield range, and that won't occur for at least a few more weeks. What a dynamic equilibrium in the 10-year market would look like would be something closer to 135 to 140 after we take down the auction, but before we try to trade the CPI numbers. And it's really the reaction to the CPI that I think will help recalibrate the market's expectations into the balance of the summer.
Yeah, I think the reaction to those two data points next week, both the CPI and even to a certain extent the producer prices. I am curious about the auctions themselves here and the participation that we might see here. With regards to foreign participation here, is that really what's going to drive it next week, or are we going to see a little bit more coming from the domestic dealers?
Well, there has been a lot of price action that has occurred during the overnight session. So some of the extreme lows that we've seen in Treasury yields have occurred early in the morning during the overnight session. So that does speak to the importance of foreign participation at the auctions. However, I will argue that given the trend that we've seen in auction participation, there is plenty of domestic demand to take down treasuries. And recall, we're about to reach an inflection point at the end of this year, perhaps the beginning of next, where not only have the nominal auction sizes plateaued, but we'll start to see them creep a little bit lower and supply will become even less of a concern.
Ian, just quickly, new range on 10s. What is it?
To 4 decimal points.
For the next month and a half, I will call it 121 to 147.
It's a fat range for the next month and a half. We'll take it, though. Ian, thank you.
That is great.
Ian Lingen of BMO Capital
That was
Markets.
just, folks, that was just a window into the real world of institutional bond management.
Ian's fantastic. One of the sharpest on the street, Tom. So we talk about that new reaction function. I think it's important. The traditional reaction function to the economic data for this market. Typically upside surprise on inflation, yields higher, curve steeper. Ian making the point that maybe it's different. Maybe it's different now, and that maybe it's that later cycle dynamic you might expect, where higher inflation prints would lead to a more reactive Federal Reserve, and therefore it's a buy on 10s. It's a buy on 30s.
It's a market call, John. You know, I'm not in the business of market calling here, and I do take the point of everyone in equities at the bond market now is leading the way. But you know, I'm just going to say it, John. I believe in the resiliency. These corporations are going to adapt. Are we going to get through this ginormous trillions of fiscal debt? You know, the reaction functions are a mystery.
We'll hear from the corporations next week. Tuesday morning, JP Morgan kicking off earnings season stateside from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Bostic this morning. Lisa, back on Monday.
Oh,
That's
she says. Isn't it? Says who?
You think she's going to be longer?
I think she could extend.
Take an extra few days.
Extend and pretend.
On Crete or not on Crete. Equity
no,
futures,
she's not on Crete.
43.35
Maybe
on
Corfu.
the S&P, up 0.5%. Genuinely, she's not on Crete. Yields are higher by 4 or 5 basis points.
Genuinely, I don't think she's on Corfu either, but we can say
134.11. Where is she?
Maybe the Upper West Side. I don't know. I don't know.
Even know. From New York City, on radio, on TV.
I didn't get a postcard, nothing.
I got nothing either. This is Bloomberg.
morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model is like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things have to be, you have to be mindful about that. But I think it's incredible what's been achieved so far, but, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
We're going to have another year or two of above trend growth. And I think that that's going to be something that we should be pretty encouraged about.
Some type of a pullback here just seems natural and normal. And this is not the reason to exit the market.
The market likes higher rates, and people just don't want to buy into that idea.
You got the stock market wondering what the bond market knows, the stock investors don't. So there's a lot of negative pressure.
When eventually rates rise, I think you're going to have a problem there. But for the moment, I think the economic and monetary backdrop is very favorable.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome all of you. Lisa Abramowitz, off, on a most unusual Friday. It is a growth scare recovery. John Farrow, just moments ago, red and green has become all green. NASDAQ 100 goes positive.
Up 0.1% on the NASDAQ 100, on the S&P advancing 0.5%. Guess where the bond market is? Lower. Yields are higher by 4 or 5 basis points, approaching 134 on 10s. And Tom, you're willing to say this one's over?
Well, I'm not willing to say it's over, but I'm saying
you said it twice 2 hours ago.
Well, a lot of people are saying it was a growth scare.
Okay.
We went through it and up we go. Ben Laidler really reaffirming that this earnings season will be definitive. What to me is unusual, John, is on a Friday, it's not jobs day. Friday, July. This has been most active. I'm sorry. The 72 points from President Biden on competition in America, every corporate officer will have to address that.
Tom, we are totally on the same page on this. This is not the summer that people expected. You see that reflected in the market. And I think next week for earnings is going to be absolutely fascinating. The divide between the commentary from macro strategists on the bond market and what you hear from the C-suite, from the corporate leaders from Tuesday onwards in America could be very, very different.
It will be. Romaine Bostic, fold this into the close and what we're going to see on earnings. And frankly, what we see at Sun Valley, all those elites are going to have to meet to greet to say, how do they adapt across 72 items?
Yeah, 72 items. It'll be interesting to see how many of those items become reality. I think the message, though, is clear that at least for the next 4 years, next 3 years now, 3.5 years now, you have a regulatory environment that's going to be a lot more scrutiny over some of these deals here. And I think that could put a little bit of a chill on some of these mega deals, but overall here, the market seems to be taking it in stride.
John, let's go to the bond market right now and really dive into this. I'm looking at the real yield. We went down to a negative 1 point whatever. We've really come back 7-8 solid basis points here, a more attractive, lesser negative number.
Let's go to the nominal yield, up 4 or 5 basis points on 10s, back through 130 after a break of 125 yesterday. Your yield, 133.77. Futures positive by 0.5%. What's the new range over at BMO? Now, Tom, on a 10-year, the low 120s to 147
I think it was,
for the next month and a half. Look, what was really interesting about what Ian Lingen had to say is basically, even if I told you what the economic data point was going to be for next week, the week after, could you tell me with confidence and conviction how the market would respond to it? And that's what the story is for me right now. It's not about the economic data alone. It's about how the market will respond to that information. And that's where the critical information is at the moment. And as a belief from Ian Lingen and of BMO and others, Tom, that upside surprises on inflation brings the Federal Reserve in, which means yields are lower, and it's a bullish story for 10s, for 30s. It's a flattener, it's not a steepener.
That debate will continue, and we'll do much more on that next week as we dive into earnings season. The other raging debate, the state of the American economy. Neil Irwin, I should say, over at the New York Times, really emphasizing a study of what GDP is doing as being the foundation study right now for all in the markets. David Riley of Blue Bay Asset Management agrees. He says, grin and bear it, it is a growth economy. David, what does the slowdown gloom crew get wrong?
Well, I think they get wrong the extent of momentum that we have in the US and I think also the global economy right now. And we still do have continuing substantial fiscal support, and I think that we're going to get more going forward as well coming out of Washington. We're getting things like the Recovery Fund will start to be dispersed towards the end of this year and into 2022 within Europe, and of course with the vaccine rollout as well supporting reopening. So I'm pretty confident. I have got a high conviction, even though the market's kind of challenging that conviction in terms of how the bond market is performing, that we do have strong growth for this year. We'll have above trend for growth for next year. I think where the market can reasonably those with contrary views can reasonably challenge is sort of say, yeah, but once we get past that, then we're going back into a sort of secular stagnation of excess savings, low growth, low inflation, and the Fed will never be able to get rates higher. It's going to end up getting trapped in the way that I think the ECB has done. I'm not as pessimistic as that. So, and I think right now the market is underpricing the Fed. So, I still think that bond yields are going to end meaningfully higher by the end of this year. But I'm taking some pain. I'm having to grin and bear that right now.
David, earlier on, we caught up with BMO, talked about the reaction function of this market, how a market responds to incoming economic data. You made the point it's not what you expect. Might be a little bit more counterintuitive in the future. The upside surprises on CPI will actually lead to lower yields at the long end, 10s, 30s. Are you pushing back against that?
Well, I think in the near term, that is because the market has interpreted the last meeting of the Fed as this, hawkish pivot, and basically decided that the Fed has blinked in terms of its average inflation targeting regime. So if you get higher inflation in the near term, that makes the Fed more likely to hike rates. But as I was saying before, people are sort of now debating this kind of secular stagnation over the medium term. But I think they're wrong on that. Both, I think that, as the data comes through, we will see higher and stickier inflation as well as stronger growth. But also, actually, that I don't think the Fed has become meaningfully more hawkish. And so at some point, I do actually expect the curve to steepen back again and to get back onto that more kind of reflationary trade.
Tom and I hate the when questions. When will that happen? But David, I do think it's important when you think we'll have sufficient information to challenge the current consensus. When do you think that will happen?
I think we're going to be looking at sort of September, October time. I mean, you know, what's important is, in addition to the inflation numbers, is also, of course, what's happening in terms of the labour market. And although we had a pretty strong payrolls headline number, the actual unemployment rate, you know, somewhat surprisingly ticked up. Now, our own forecast suggests that unemployment is going to be approaching 4% by the end of this year. So I think, you know, when we get to sort of October, we'd have had a number of payroll reports, including, you know, the September payrolls, which will start to reflect some of the runoff in terms of the extended unemployment insurance, you know, kids returning to school, you know, mums getting more access to the labour market as well. So some of those sort of labour supply constraints may start to dissipate as well.
So, David, so as we sort of try to assess this growth story, this growth scare, whatever we want to sort of call it here, can you maybe walk us through the divergence that we've seen lately between what's been going on with regards to sovereign debt and what's been going on with regards to corporate credit? Because they seem to now be uncoupling maybe just a little bit.
Yeah, I think it's a good point. That, I mean, one aspect of, you know, what we've been seeing of late is that while, you know, we've seen the volatility in the rates market, we've seen the equity markets starting to respond to that and thinking, you know, the bond market is telling us that, you know, growth is slowing and potentially meaningful. Credit's actually held up pretty well. Now, in part, credit doesn't need sort of really strong growth and corporate earnings growth in order to, you know, be still a relatively attractive from a carry perspective. But I do think also the credit market right now is sort of saying, well, you know, yeah, okay, maybe growth is, you know, maybe moderating, but that's, you know, it's not waving any kind of red or even amber flags, in my opinion.
David, my observation is you're not focused. I mean, that's all I can see now. John, this is just simple. Riley is focused on one thing, and it's what England is going to do against Italy. Let's get to it. How do they do this, John Farrow and David Riley? Does England have to come out strong? It's the when question right now. When does England do it? Do they come out strong in the first half, John, or do they have to be patient and come out strong in the second half?
I think a lot of it comes down to one player for England. David, I'm sure you agree. Raheem Sterling has just been a standout performer. Player of the tournament for England. If he turns up, there could be a bit of trouble for Italy. He's just been absolutely fantastic.
Yeah, I actually think Italy overall are the actual better team, but England do have home advantage. So I am hopeful that will be enough to kind of get us over the line. But as Jonathan said, yeah, I mean, Raheem Sterling running at the Italian centre-backs, I think, could cause them some problems, particularly if they touch him.
And, of course, which Italy turns up? The one against Belgium or the one against Austria? I'm more interested in London.
They won 33 matches in a row, John.
Unbeaten 30-plus games. The City of London, Tom, Monday morning. How does that work, David? What have you said to your team? Are you turning around to them and saying, look, I don't expect you to be in early on Monday morning after the big game? What are the expectations from the staff in the City?
Well, I've told them don't expect me to be in.
Oh, you've told them that. What about them, David?
No, they've got to be bang in there. Right? I mean, someone's got to work. I mean, don't forget, I'm a lot older, so I've got to sleep. Free time. I do need my sleep. So yeah, I mean, hopefully you know, we won't there'll be a little bit of you know, positivity and euphoria, maybe a sort of cheeky long Sterling trade.
We should send a camera out to Bank Station, just outside of Bank Station, Tom.
Yeah.
On Monday morning, I'm telling you, tumbleweed all the way through to lunchtime.
It's called bunk, right?
Bunk. Yeah. Bunk.
Yeah. What I noticed here is David Riley just, you know, he was not focused until we brought this up, John, and he's just full on right now.
I would agree. David, in the zone. David Riley of Blue Bay Asset Management.
Thank you.
Chief Investment Strategist. TK, Monday morning, it's going to be dead. I'm telling you. No one's turning up.
I mean, even the Prime Minister, and you saw at the end of the game the other day, Prince William clapping as well. John, let me ask, does the Queen show up?
I don't think the Queen is showing up. I imagine Prince William attends the game again.
I mean, it's like a huge...
I would expect Prince William to be there. First major final since 1966, Tom. It's been a while for the England national team. It's a big moment for the country.
How did they get here?
They had a favourable draw. Okay, 2 points I'll make. One, they had a favourable side of the bracket. Okay. But the second point I would make, is that unlike the previous England teams, which, to be honest with you, I detested because of the attitude of some of the players, this team's really quite likeable, Tom. It really is. This England side,
unlike Bloomberg surveillance,
is really quite likeable, like this team too.
It's quite likable.
With the exception of you and I, 43.34 on the S&P, up about 0.5% from New York City.
Oh, Lisa, come home.
For our audience worldwide, Guy Johnson writes in, it's dead on Monday anyway. Everyone works Tuesday, Wednesday, Thursday. The new way of things in the city. Thank you, Guy. Guy Johnson coming to you in about 2 hours' time. From New York City, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden is signing a wide-ranging executive order today aimed at promoting competition in the economy. Amongst other things, it calls for supporting programs that would import cheaper prescription drugs from Canada, save consumers money on their internet bills, and make it easier for people to get refunds from airlines. The president also seeks greater scrutiny of mergers within the tech industry. The largest business and labor organizations in the U.S. are joining forces to push for the $579 billion infrastructure bill. The Chamber of Commerce and AFL-CIO are on board, along with groups representing manufacturers, retailers, and builders. President Biden and a bipartisan group of senators brokered that agreement last month. And billionaire Richard Branson made his reputation with a series of daredevil exploits. He returns to that on Sunday when the 70-year-old is scheduled to take a rocket-powered trip to the edge of space. The test flight of Branson's Virgin Galactic craft would be a step towards carrying ticket-buying passengers. And Bloomberg will have complete coverage of the launch on television, radio, and Quick Take this Sunday, starting at 9 a.m. Eastern. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro. Together this morning with Romain Bostic. Lisa Abramovich is back with us on Monday, and here's the price action. This Friday morning, equity futures are positive 21. We advance 0.5% on the S&P. The Nasdaq 100, that's advancing 18 points, up by 0.12%. Outside of that, we're taking our cue once again from a bond market that's seen 8 straight days of yields lower. Today, yields higher. 4 basis points to 133.60. And Tom, just quickly, briefly, in the interest of balance, after all that so-called soccer talk, someone writes in, no idea what the percentage of your audience is American, but those of my generation have 0 degree of interest in soccer. Game using head to strike a ball is just dumb. So, you know, just putting that out there for the other people out there.
Did Romain send that in? Romain, did you send that in?
Was that you, Romain? Is that your ghost account on Twitter? I understand people feel like that, Tom, on that particular sport.
I am in Romain's camp, but I do enjoy watching.
You're trying. I know. I feel like we've converted you. I think we have.
John, the big distinction here is Americans were foisted subpar soccer. And when we see world-class soccer, we're like, oh,
don't you
that's
think
really interesting.
if we had the World Cup here tomorrow, that it would be massive in this country? I think it would. I think it would be huge. Be nothing like '94, where there was very little interest in the game, Tom.
Yeah.
I think if it was held now, it would be huge.
Dr. Dudley's going, what are they talking
Dr. Dudley would be
about?
buying tickets for those games, Tom. You know he would.
Joining us now, William Dudley. He is of Berkeley. He is of Goldman Sachs and, of course, the former president of the New York Federal Reserve, and we're thrilled he could join us, and he writes presciently on labor this morning. Bill, I don't want to go into the details of President Biden's 72 points on the power of corporations and the consolidation of corporations and the weakness of labor. You do address it this morning in your note, but I want to go back to an important article you wrote 6 years ago. What kind of jobs have been created? Bill Dudley, how did we get here with declining labor share?
It's not really clear exactly why labor share has declined so much over the last couple decades. Presumably it's because corporations have more power. Antitrust policy has been less aggressive in dealing with anti-competitive practices, and I think labor's power from a unionization perspective is also lessened. But it's also a question of how tight is the labor market. Through much of the last economic expansion, there was an excess supply of labor. We only got close to full employment at the very end of the last economic expansion, then the pandemic hit. So I think the key is going to be, can the Fed drive the economy to full employment? And if the economy is at full employment, then I would expect labor to do better and pick up a bigger share of income.
The primal scream of this document and the political energy that supports it, so that supports President Biden, seems to be about a blanket of technology over this generation. Do we underestimate the technological effects on our labor economy, on our American economy?
Well, I think there is no question that the digitalization of the U.S. economy has had pretty powerful effects on the return on capital and the return on labor. I think the ability of people to search now through the labor market and find people to employ is vastly different than it was, when people used help wanted advertising to attract workers to employ them.
Bill, there's some belief that maybe Labour has started to get a little bit more power as we work through this reopening. You've written today in your column, is the labour market too loose or is it tight? Is it loose or tight? And Bill, your answer is both. Can you walk me through the thinking, Bill, in your latest piece?
So it's loose in the sense that if you look at the unemployment rate's still elevated compared to where we were in February 2020 when the unemployment rate was 3.5%. Right now it's 5.9%. It's loose when you look at the number of people who are actually employed. We're 7 million jobs short of where we were in February 2020. But if you look at it in terms of how many job openings there are, the number of job openings is at an all-time record. We have 9.2 million of open jobs. Businesses have a lot of jobs to fill. They can't find workers. You actually hear about that anecdotally in the Federal Reserve's Beige Book report, where they talk about how businesses literally can't find workers to hire to do their work. And then some businesses actually are cutting back their hours of operation because they can't find enough workers to keep their output up.
So, Bill, when we talk about, though, the power of workers here, when you go back decades prior, there was an argument to be made here that it was the mobility of workers that also gave them a lot of power, and that with the consolidation of industries, with the decline of labor unions, that sort of leverage is just not there the way it used to be. Is it possible to bring that back? Is it possible for that to be done at the behest of government policy?
I think it'll be difficult because mobility has declined. The willingness of people to move from one geographic location in the U.S. to another is much lower today than it was 20, 30 years ago. And part of that's the aging of the population. As people are older, they're more attached to where they've lived historically. So I think it's really about the Fed. It's really about the Fed getting the economy to full employment. If the Fed can get the economy to full employment, make the labor market truly tight, then workers will have to, businesses will have to pay up for workers, and workers will get a bigger share of the pie.
Bill, let's talk about the Fed just briefly. You've talked a lot about the risk, the balance of risks around a Federal Reserve, that once they do lift off, that trajectory won't be as shallow as the trajectory we saw in the previous cycle, a Fed that you were a part of. Do you still feel that way?
Yeah, because they basically said that we're not going to even begin to raise short-term rates until three conditions are met. The economy has to be, at their view, of full employment. We have to hit 2% inflation, and they have to be confident that inflation is going to go above 2% in the future. That's very, very late to actually begin the tightening process in terms of lifting off in terms of short-term interest rates. Before, they used to try to hit, they lifted off early with the idea of hitting 2% inflation, full employment, and a neutral federal funds rate all at the same time. We're not going to do that this time.
Bill Dudley, important final point. And Bill, good to hear from you, as always. That piece is out on the Bloomberg terminal this morning and on Bloomberg.com. Is the labour market loose or tight? The answer, it's both. By Bill Dudley, the former Federal Reserve Bank of New York president. Tom.
John Ferro, it goes back to two Americas. I remember the clear, I believe it was John Edwards standing on a Louisiana subdivision lawn where he did a political event and he started talking about two Americas. That's accentuated, I think, of Jeffrey Sachs, who was way out front on the challenges to labor in America. In this document this morning, as Blanche Flower of Dartmouth said, it's just there, it's policy. Does it have any power? Does it have any strength? It is a marching call for corporations to respond. Every single one of those items, John, they are going to have to respond to it.
The emphasis is clear, and I think the emphasis is worth pointing out. Romain, this is about competition.
It is.
I think it's something we all want to see.
Yeah, and I think at some point, it would just to Tom's point, too. I mean, if you're a major corporation looking to tie up with another major corporation, the question is, does this maybe give you second thoughts about this, or do you sort of move forward with it and try to test this new policy and test this administration on what it thinks are anti-competitive practices?
We are going to talk to Terry Haynes of Pangea Policy about this particular release in the last couple of hours. From New York City, we'll head down to Washington, D.C. next. Alongside Tom Keene, I'm Jonathan Ferro. Together this morning with Romain Bostick. I believe Lisa is back on Monday. And Romain can get some sleep maybe next week. Romain, would that be nice?
Yeah, absolutely.
A little rest, a lie-in. 43.34 on the S&P, up a 0.5% to 1%. We don't eat breakfast on this program. Do you go to the gym?
Yeah,
do you?
I used to before I started doing this show.
This is Bloomberg.
Ask me.
you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
Back in the kitchen, I have many friends.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Okay, traders, I need to place further my stop on profit for euro. All of you guys who decided to copy my trades, and especially these trades, you see, great, well done. We're making profit nicely. So let's move 5 pips higher. So 118,449.6. Okay. We placed higher 115.49.6. We purchased, as you can see, 20 past, something like that, in this time, the euro against United States dollar, and right now it's look like it kind of trying to find direction at 118.61. Okay, so we placed stop on profit. Whatever happened, you will not close your trade in loss. We're already in profit, and you guys already in profit as well. If it will move higher, we will increase our profit. If it will move lower, it will get filled at the level 118.49.6. So we'll get, in our case, we'll get £1,500 in profit. Okay, stay safe, guys. I'll speak to you later.
Correspondent Anne-Marie Jourdain this morning. Anne-Marie, this administration very, very focused this morning on competition, competition, competition.
Yeah, and it's all across a plethora, Jonathan, of industries: agriculture, banking, shipping, internet. What's so distinctive of this executive order, it's very much similar to that from the Obama administration, but under the Obama administration, it was in 2016, the end of his administration, and a lot of the things that were in that executive order have since been rolled back under former President Trump. Now, this executive order is targeting a number of industries, big tech, one of the biggest. And what's so interesting about big tech is that this could probably have bipartisan support. It's, of course, going to agencies of regulators, but potentially we can also see Congress look at some of these executive orders and want to push through some amendments as well in terms of legislation. We already see House Republicans looking at taking on big tech, especially when it comes to censorship. And then as well, pharmaceuticals. That's another big one. I mentioned that because yesterday Speaker Pelosi was talking about very similar legislation that she wants to get through the budget, through reconciliation, when it comes to lowering pharmaceutical companies. But what is very clear is that this administration is not just encouraging it. They are really laying out very poignantly what these what these agencies can do to start fixing some things where they say there's just not enough competition.
Anne-Marie, finally, score, Sunday, go.
Forza Italia. I don't know what the score is going to be, but I hope Rome brings it home.
Thank you. Anne-Marie Jourdain of Bloomberg down in Washington, D.C. Thank you very much. A lot of people reaching out about this sport on the Bloomberg terminal this morning. Here's the quote. The non-stop play and skill exhibited by top soccer players eclipses the commercial timeout-ridden average NFL game. And I heard a great line on the NFL the other day, Tom, that if they had the same time format as soccer, in inverted commas, you would have a very different physical appearance of football players in the NFL because of the endurance that would be required. The game would be more intense. and it would be far more interesting.
John, I said on the couch, what was it, 2 days ago with Denmark, and I said to Mrs. Keene, I said, the NFL should go to the soccer clock. I don't know what the length
commercial breaks are just terrible.
What it would be.
Yeah.
But it would be so much more of an interesting game, I think, without the slow.
And don't you think it would be quicker, Tom, because to have that kind of endurance through 90 minutes with only one break, naturally the physicality would go a little bit. You'd have to be a smaller player. It would be more nimble,
football,
agile.
John, I was on the back end of where you went both ways. You played offense and defense, so there was a lot more. But I have an immense respect for the clock of soccer. Like, let's get to it, let's go. And they still seem to make a little bit of money around it. It is the most interesting Friday. None of us were prepared for how fascinating this is. Futures up 21. NASDAQ puts on some green, not in 2 points, but the VIX in nicely. The Dow futures just barely below their high of July 6. We want to drive forward the conversation of the Washington response to this extraordinary document by the Biden administration. Terry Haynes is with Pangea Policy and the founder, and he is a student of Washington and all the white marble buildings down there. Terry Haynes, who will be most affected by this document, Republicans or Democrats?
Oh, I think affected politically. I think what Biden is doing politically is trying to shore up his left flank here. He's given progressives a lot of things that they want, and for markets, I'd say really two things. It's firstly, Biden's getting a lot of kind of bunches of good government, sure, why not sort of things, airline refunds, drug pricing, generics. But this is a long-term wet blanket on merger and consolidation activity, among other things, which as you all know, is a very large driver of the U.S. economy, and it is something that, to use George Will's great definition of American football, committee meetings punctuated by violence. At least you have, you'll have these long committee meetings with the regulators, and then they'll do things. But at least the market impact, I think, is mitigated somewhat by the fact that the regulators have now been given everyone a roadmap as to what they intend to do in the next 3 years, so you can at least defend against it from a market perspective.
Terry, I'm going to go all early Three Dog Night on you here and go back to 1970. We can do this with the 50th anniversary of Crosby, Stills, Nash & Young's Deja Vu as well. Terry, let's go back to 1970 in a book all of us had to read at gunpoint. Alvin Toffler. I mean, it was like you had to carry it around campus, so you were cool. And the future shock of all of this was too much change in too short a time. Is this too much change for moderate Democrats to see essentially a liberal manifesto?
Well, I think there's a lot of pressure in the Democratic Party right now. And, I've been preaching four factions in Washington for a long time, not two political parties. So these two, the tectonic plates are rubbing up for a lot of different ways. But, what this does for Biden is it buys him some political goodwill with progressives. And at the same time, it takes a lot of pressure off the centrists because, they can all point to the regulatory agencies which Congress created and that by and large exercise congressional power, like the Trade Commission, and say, look, they're investigating. We can, deal with this. So in some sense, it's kind of normalizing the calls around changes in big tech and other things. So I think you see the pace of a lot of this stuff for markets, frankly, becoming more deliberate and therefore easier to defend against.
It's Terry, just in terms of this particular order, this of course is an executive order, but when you look at things, is there some substance here that you think Republicans might be able to go along with, particularly on the competition stuff?
Well, specifically on the competition stuff, I think not, John, because I think what's underappreciated is everybody wants to criticize, in Washington, wants to criticize big tech. It's very de rigueur to do so, but nobody agrees on the what or the how or the why. Republicans don't particularly care about the size of these companies. They're concerned about censorship and being able to make sure that points of view are put together. Whereas the principal criticism from Democrats, particularly from progressives, has to do with the size of the companies, and not so much at all with the sorts of things that they're putting out and the sorts of censorship that they're engaging in. So there's no commonality behind a lot of this stuff. So I always find this idea that big tech is under the gun to be overblown. It's definitely they're turning the barrel, but that's different than assuming that there's some sort of large imminent action that's going to happen. And even if it comes from the regulatory agencies, it'll be litigated endlessly. It's more like, that 70s show is entirely apropos, because it's more like the AT&T consent decree and large regulatory matters that happened in the 70s that ground on for years than it is anything quick and decisive.
Just in conclusion then, Terry, for people watching this program, listening right now, who hold some of those big names in big tech, and it might be bad, it might be good if they get broken up for those shareholders. I won't make a point on that this morning, Terry, but you think the regulatory push is just optics, there's no real substance, no teeth?
Well, I think they intend a substantive push, yes. Do I think that there's anything in the short to medium term that ought to concern investors in that sector? No, I don't. It's headline risk and nothing else.
There's also sort of an idea here, though, Terry, some elements of this that could actually benefit workers, some elements here that maybe won't receive as much pushback than some of the competition issues themselves, meaning the headline consolidation issues. I'm wondering, with regards to some of these issues with regards to mobility of licensing, some of the right to work issues as well, sure. Do you think there's the potential here that could actually make it through relatively intact?
Yeah, I do, Romain. There's an awful lot, and I'm glad you came back to that, because, as I said, there's an awful lot of, kind of good government, sure, why not sorts of things here. And you bring some of them up, things that will be popular, broadly popular with voters, and actually get some bipartisan support. Kind of airline refunds, drug pricing generics are two things that come to mind. And, speaking of which, I think that the markets completely underestimate the likelihood of drug pricing reforms this fall. I have it now up to 70% that's likely. There's a big push from congressional Democrats, and Biden would certainly sign it if it came to him in a spending bill. So, a lot of that stuff is just, and it's hugely popular among Republicans and Democratic voters alike. So a lot of this stuff is keyed, and appropriately, if you're the White House, to make sure that they get credit for whatever it is that the regulators do, and that's fair enough since he appointed the regulators. So, it has some political benefit for him, and it has some political benefit for Congress as well, and I do think some of that good government stuff happens, sure.
Terry Heinz on the executive order from the president from the White House this morning. Pangea Policy founder. Hey, Terry, it's good to catch up, sir. Thank you. Ongoing dialogue with our audience this morning on my football, you call it soccer. Okay, here's the quote. Another one. Permit me to inform that the most difficult thing to accomplish in sports is hitting a small round object traveling 95 miles an hour and hitting it 380 plus with a wooden bat, not kicking a ball the size of a watermelon. Tom, just some of the feedback I'm getting this morning. Is that hate mail? Do I call that hate mail?
That's hate mail.
That's hate mail. Thank you. Thanks for clarifying.
John, everyone should sit once behind home plate directly and watch the ball movement that comes in. You do not see it on TV. It is frightening, some of these people, 95 miles an hour plus, how when it's on radio, I'm moving my hand around. You know what I'm talking about. The ball movement's stunning.
And Tom, I've done that, and I appreciate the skill involved, and also something that surprises you once you get at that level, the arm on some of those players, that throw into third base that you see across the field.
From right field.
From right field to third base is something. When I watched, I think it was Aaron Judge, I watched do that. It was phenomenal. Yeah. Absolutely phenomenal. Do you like that little bit of baseball knowledge from Yankee Stadium?
And Romain, to do that at Comiskey Park, way out there in the depths of right field is something.
Yeah, real something here. Is there a soccer chat that I'm not a part of?
It's just incoming messages from the viewers on the Bloomberg.
It's okay.
I like to be included.
You don't have to
see you in future.
Romain, can you get Caroline Hyde to step it up in the afternoon on English football?
I don't think that's what Romain wants, to be honest with you, Tom. Romain Bostic coming up a little bit later on the close with Caroline Hyde and Taylor Riggs. Alongside Tom Keane, I'm Jonathan Ferro.
Alarian will have an
On
opinion.
Monday, we'll catch up with Lisa. She'll be back from Knot Creek.
So you say.
Mohammed's going to be joining me on TV in about 20 minutes' time, alongside a whole host of guests on what's been going on in the bond market. Then on to Real Yield a little bit later this afternoon.
Anything else after Real Yield?
No, I'll be going home and having a nice little weekend, all right? Then you and I can catch up later. From New York, this...
Maybe you'll spell weekend.
It's Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden is signing an executive order that will lead to new regulations on everything, from airline luggage fees to non-compete clauses. It's designed to promote competition across American industries. Regulators are being called on to increase scrutiny of tech companies, drug prices, and much more. And President Biden's team is concerned that time is running out to revive the Iran nuclear deal that Donald Trump abandoned. There have been 6 rounds of negotiations in Vienna, and there's little sign of when a 7th might start. The stalemate is compounded by Iran's technological advances and the election of a new hardline president. China's trying to make it easier for banks to go lend to smaller businesses. The central bank has cut the amount of cash that it must hold in reserve. The People's Bank of China cut the required reserve ratio by 1/2 of 1 percentage point for most banks. That should free up about $154 billion into the economy. For now, cash is still king. At Sotheby's in Hong Kong, a 101-carat diamond was sold for $12.3 million to an unknown buyer using traditional currency. That disappointed cryptocurrency fans. They hoped the buyer would take Sotheby's up on its offer to accept Bitcoin or Ether. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I'm quite confident. I think that a lot of work has been put into these negotiations. There was a major breakthrough with the new administration on the other side of the Atlantic, obviously. And I'm confident that we will have a deal that sets the basis, you know, for the appropriate legislation throughout the world.
The discussion at the FinMen meeting in Venice, Italy. It's actually a spirited meeting, very important for Europe as well, on taxation and such. We need to get an update. Romaine Bostic in for Lisa Bramwitz. I'm Tom Keene. Mr. Farrell getting ready to drive a market with futures up 19 forward this morning. Joining us now from Eastern Venice, the depth of Eastern Venice and the Arsenale, Maria Taddeo joins us. And folks, what's so important here to understand is that from the Arsenale, you go down past the acclaimed El Covo restaurant and you go along the canal in the water there, past the Metropole, past Daniele, and then you get over and just a little bit further after an arduous walk is Harry's Bar. Somehow Maria Taddeo will get there today. Within the celebration, Maria, what's actually getting accomplished at this FinMen meeting?
Well, look, Tom, on the one hand, it's an interesting question because a lot of the ministers here, they say they're very confident there will be a deal on taxation. They say this is really nothing short of a tax revolution that we're seeing. But actually, if you speak behind the scenes with ministers here, they still tell you there's a lot of issues that are pending here. One is a 15%. We know that for the Irish, a minimum corporate tax at that rate is very problematic. The French, they already say this morning that they want to take it even higher. For the Americans, the fact that the European Union is still going ahead with their own digital tax is problematic. And of course, all of this is happening in the context of coronavirus. Again, this new wave taking hold in Europe. So there's a lot of smiles, there's a lot of pictures happening here. Right. Of course, it's a beautiful day in Venice, but behind the scenes, there is still a lot happening here that needs to be resolved. Is Secretary Yellen and her troop visible, or are they down at Harry's Bar? We actually saw her with a big delegation crossing the river on the boat. You know, that boat they call Vaporetto in Italy. She was in it this morning with a big delegation. But I have to say, we haven't seen her on site. We did see, however, Christine Lagarde taking a walk. But, you know, we haven't really heard from her. We haven't really seen from her yet. Oh, then the boat. On radio, I mean, Romaine on radio, the boat in the background, and Maria, I mean, Romaine.
Okay, guys, I'm going to move further my stop and profit for euro to 118.54.6. Okay, please change your stop and profit to 118.54.6. Speak to you later, guys.
Of keeping these borders open, and more importantly, just keeping sort of the wheels of this supply chain, this global supply chain greased here, that has to be a concern that's going to be on the table this week.
Yeah, look, certainly, and a lot of this will also show, and the Americans in particular will want to show that this is the end of politics by tariffs, it's the end of politics by tweets, and that the United States is very much at the table with this. On that note, Romaine, however, I do have to stress the European Union is putting forward next week a digital levy. They're also putting forward a carbon tax, and there is concerns that this is going to be very difficult for the U.S. Congress to approve, that a lot of these companies are based in the U.S. will say, hey, we're being targeted just because we're Americans. So this is still very much playing in the background. Of course, again, I do have to say they do want to stress that this is a very different mood now that President Trump is no longer in the White House.
So that raises the big point here. If we do get an agreement on taxation, if we do get some sort of agreement on trade here, I mean, how much can investors, how much can the public here expect these agreements to hold?
Yeah, look, we'll have to wait and see. And again, when you look at especially the corporate tax, what critics will tell you already is that big companies, they always find a way to reduce their tax bill. And 15% to some extent for the Europeans is actually not that much. In many of the European countries, they pay more than that. I think what is key here will be that shifting where you no longer go into low tax jurisdictions, but you're actually able to pay in the country where you make your services. That is the key for Europe in particular. It's not so much the tax rate, which should go up to some extent, but it's the fact that they will finally be taxed in European countries according to this new legislation.
Maria, I've got to ask here, after you're at Harry's Bar, you're going to go down Calaveras, I believe it is, to Celine and Balenciaga and all that. Is Venice back? I mean, is your observation there that Venice is up and running with summer tourism or not?
Well, look, that's an excellent question, and I did go and I walked past Celine. I didn't go inside, I have to say. But the tourists right now here in Venice, they're all Americans, and that was really to me quite striking. Usually here you get Germans, you get French, you get pretty much a lot of Europeans in Venice, but yesterday was purely Americans, and actually I would say half the normal business that you would see around this time, and no Chinese tourists. That's a huge hit for a city like Venice.
That really is. I've actually witnessed that myself. It's just really something to see. Maria Tadeo, Tough Lifty, thank you so much reporting from Venice this morning. Romain, let's set up the market here into a most eventful week next week. What are you going to focus on in the close this afternoon?
I think it's really a look ahead to next week. It is jam-packed. Obviously, you get the big bank earnings. You get a few earnings out of the healthcare companies. You got Jay Powell on the Hill for 2 days of testimony. I'm sure there's going to be a lot of focus there on monetary policy. And don't forget, you've got a couple key Treasury auctions coming up on Monday. And on top of that, of course, you get another read both on inflation data here in the U.S. as well as retail sales here. So investors are really going to have a lot to chew over here and really make a determination of whether this so-called growth scare that we got this week, Tom, whether that is really something you need to be worried about here going forward.
Mohamed Al-Arian, he will be with John Farrow, I believe, in the next hour. I'm not sure which Farrow property Romain will be in, but Dr. Al-Arian watching Maria in Venice and is dazzled, Romain, by the need for surveillance to go to Venice to do a remote. He says he will show up for that remote.
Yeah, I was very jealous of that shot there. I mean, absolutely beautiful out there here, and here we are stuck in this studio. I think next time I co-host here with you, Tom, it's got to be on location.
Could be Monday. We don't know if Lisa's going to be back.
Lisa will be back.
As well. Romain, the other thing I want to look at and really emphasize is these conference calls this time around will be never more scrutinized than they will now.
Yeah, everyone wants to really hear the commentary. I mean, the numbers themselves, I mean, yeah, they matter, but at the end of the day, it's really about the sentiment, not only just the forecast, but really the sentiment that we hear out of these CEOs, out of these CFOs about these businesses going forward, about how their customers are interacting with them, their clients are interacting with them, and more importantly here, just the overall tone here about the trajectory of this economy.
It will be most interesting. A special program note, and this is in the week of space that we're going to have with Mr. Bezos from Sun Valley and Idaho out to his effort up into the edges of space. Sir Richard will as well. They are doing an Alan Shepard. We can go back to Mercury and to that time where you go up and before John Glenn, not into orbit, but to get to the edge of space. We'll have special coverage of that on Sunday. Look for that as Virgin Galactic launches at 9 a.m. Really most interesting. I believe at 3 p.m. New York time also there'll be a football, soccer game. Romain Bostic may tune in. Just may. We're not sure. Stay with us on radio and television.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City for our audience worldwide, good morning, good morning. Equity futures positive 0.4%. It's this one right here setting the tone again, except this time yields are higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. Just what is going on?
Investors are deeply confused. You've had a correction in cyclical equities. Cyclical parts of the U.S. economy slowing over. Yields have been correcting.
40 basis point move lower it's no joke.
What's happening with yields?
The bond market is the thing that leaves me scratching my head the most.
We're at the half, and it's 1-all. We've got an interesting situation going on here. Active bond investors won the first quarter.
Yields just backed up too far, too fast.
The central banks and their aggregate large-scale asset purchases won the second quarter.
The market is really torn. We're transitioning out of the broad reflation regime.
People questioning the timing of the Fed and the tapering.
What the market is doing is it's reassessing how confident it is.
Joining us now, Kathy Jones of Charles Schwab, Mohammed Al-Erian of Queen's College, Cambridge. Mohammed, I'll start with you. I've asked this question every single day this week that I've been on this program. What is going on?
So I think, John, we have confirmation today that what was going on was mainly technical in nature. People being caught offside, people forced to cover their duration underweights, their duration shorts, their liability shorts, that sort of thing. I do not think that was fundamentally driven, but we learned something very important, which is lower yields are not always good news for stocks. And that's an important thing to remember going forward.
So, Mohammed, let's start there. Technicals or fundamentals? And Kathy, I'll put that question to you. Technicals or fundamentals?
Oh, I think it's a combination of the two. You had people off sides in the first quarter. They tried to get on the right side in the second quarter, and they got hurt, so they got squeezed in both directions. But there's also a fundamental story, I think, and that's the sum of we have priced in. We priced in at 174, a lot of the reflation. Then we got a slight pivot from the Fed, which historically, means that people start to price in perhaps tighter policy down the road and less inflation, et cetera. So, I think we had a combination of the two, and it just was kind of warp speed up and down.
That's the issue, isn't it, Mohammed? Even if you say it's technicals, some people might use the short squeeze that we've seen develop over the last month or so and develop or reinforce a broader narrative about what's happening in this economy. Can that take on a life of its own?
It could. So there's three elements, John. There's technical, there's fundamentals, and there's policy. And we've talked about the technical side. On the fundamental side, there are some headwinds to the growth story, U.S., China, Delta variant, and you saw what China did today that suggests that they do have concerns there. So there are headwinds to global growth. I don't want to say that don't exist. But they don't justify the extent of the move and the levels that we're at. There's the third element, which is policy. A somewhat more dovish ECB that could have contributed. So it is all three, but the question is the balance between the three, and we're going to figure out in the next few days. As I say, my gut feeling is that this was mainly technically driven as opposed to policy or fundamentally driven.
Can I take it a step further then, Mohammed? If you believe that, do you think that ultimately around the corner in front of us are high yields?
So I do think that down the road, there are high yields. I do think that the market is underestimating the inflation shock we're going to go through, and next week is going to be interesting. It's not going to answer all questions, but it's going to start giving us more data. And I also think that the market underestimates that the Fed has fallen behind, and that there's going to be growing pressure within the Fed to accelerate that timetable.
Well, let's talk about next week. We caught up with Bring Capital's Conrad de Quadros on the week ahead. Take a listen to what he had to say.
A lot of important events next week, in addition to the CPI report, which I think is likely to show another pretty elevated reading. But we also have a lot of growth data as well. We have the retail sales report. We have industrial production. Both of those reports are going to be dampened by supply chain issues in the auto sector. And then, of course, away from the data, we have Fed Chair Powell with these Humphrey-Hawkins testimonies, and that will be a key as well.
Mike McKee with us now, our Bloomberg International Economics and Policy Correspondent. Mike, we've got the supply from the Treasury on the debt side. We've got testimony from Chairman Powell. We've got earnings. We've got data.
Yeah, I'm going to leave the technicals to the charts people, but fundamentals, you want fundamentals? We got fundamentals next week. It's almost all about prices as we see, you look at the calendar, consumer prices, producer prices, and import prices all out before Jay Powell starts testifying. And to put it in terms that meme traders might understand, Powell's going to need to have diamond hands, because if you look at the forecast charts for CPI and PPI and where they are now, they're well above the Fed's tolerance level. It'll test his Alfred E. Newman, what me worry, transitory argument, because members of Congress aren't going to like that kind of chart, and they're going to worry it's going to continue. The other big number this week, as Conrad just said, Friday's retail sales, bonds suggesting this week it's growth you should worry about, not inflation. Yet economists in the latest Bloomberg survey out just now see growth rising in the next couple of quarters, faster than they thought in June. Does that continue? Do we get that to play out? That's a hard question to answer, but take a look at this. This is the retail sales report, and as you can see, we have had rebounds from down months in the past couple of months, but the forecast this time is not for a rebound, and that could ruin your Friday trade if you're betting on growth.
Mike McKee, and what to expect next week, and what a lineup we've got next week. Chairman Powell testimony, a ton of bond supply from the Treasury, the economic data Tuesday morning, July 13th, we have CPI, and then, of course, also, we get some earnings from JP Morgan kicking things off. Mike, thank you. I want to turn back to Mohammed Al-Aaron and Kathy Jones, still with us, and I want to talk about what's been going on with this market. Kathy, it's not just about the incoming economic data, and I've said it repeatedly all through this week, and I say it often as well. It's about how a market responds to data too that is critical. And if you take a look at something like the 530s curve, I think this captures it beautifully. This was from Ed Bradford out on Twitter. The second peak of the 530s curve occurred this year on May 13th. That was 24 hours after a massive upside surprise on CPI in the April inflation report. And Kathy, you have to pay attention to that. This market is not responding to incoming data in perhaps the intuitive, traditional way at this stage of the cycle.
Yeah, I think it's behaving more like late cycle. And keep in mind, we all know that inflation's a lagging indicator. So I'm not sure we're going to get big reaction to CPI or other inflation data unless there's a strong belief that the Fed is going to tolerate it to the extent that it's going to get out of control, or that it's going to be long lasting. And so I don't think that that's a belief system in the market. And part of the reason that the curve flattens and tends to come down well before the Fed's first rate hike is because people believe the Fed will have that reaction function. So on average, yield in 10s usually peak 6 to 12 months before the first rate hike. At least that's been the case in the last 3 major cycles. So I'm not sure that current inflation data is going to be important. It's going to be the prospects for inflation. And I think that's what the market's telling you. It really does believe this inflation is transitory.
Let's sit on that reaction function because I do think it's important. You mentioned it. Mohammed, I want you to weigh in on it. BMO's Ian Lingham was on the show with us a little bit earlier this morning on TV and radio, and he made the point that he thinks the reaction function, how the market responds to the data, is as follows. If you get an upside surprise on inflation, we begin to price in a more active Fed. We bring the Fed forward, and therefore an upside surprise in the data is actually bullish for the 10-year, bullish for the 30-year, and it will lead to lower yields, flatter curves, not higher yields and steeper curves.
So, John, the answer is we don't know because pricing has been so distorted that we are starting from initial conditions that don't make much sense to begin with. And then we're trying to look at incremental elements. I mean, how many people would have predicted that the 10-year would dip below 130 in early July? Very, very few, if any. Maybe one or two that I can think of. I mean, there's a bigger issue. And one is, first of all, what is the information content of the CPI and the PPI? Normally, the CPI would be a lagging indicator, wouldn't have that much, but it does this time around because this print will no longer have the base effects, which is a major transitory element. So we're going to get a handle on this transitory versus persistent, not the complete story, but a part of that story. Secondly, PPI. People have forgotten that there is a time lag between PPI and CPI. So let's look at PPI. Let's look at imported prices. Let's see how much inflation is in the pipeline. And finally, the earnings. We're going to hear from companies as to their ability to pass through higher costs. And we know they're having higher costs because of the supply side disruption. That is now the speed limit to lots of growth in the economy. It's the supply side, not the demand side. So we are going to get a lot of information coming out, but it's very hard to predict how the market is going to react to them because the market is starting from such distorted levels.
Kathy, that's the big confusion, and Mohammed is bang on. People don't understand the economic data. They don't understand how the market will respond to the economic data, and I don't think we have a clue right now with any degree of conviction, confidence, or accuracy on where on earth we are in this cycle. The kind of reaction function that we're talking about at the moment is something you would expect a little bit further down the line when you're looking for Federal Reserve rate hikes at a time when the Federal Reserve has said we're having no part of that. Do you think there is some confusion about where we are in this cycle at the moment, Kathy?
Oh yeah, absolutely. I mean, this is not like any cycle we've had in the past, and so this is one reason I think we've had such volatility and such a wide range in the Treasury market. You know, you came into the year and people expecting rates to stay low, and the rebound in economic activity was so much faster than expected. Yields shot up. Now, you know, we have hints maybe of a little bit of a slowdown where Fed reaction functions come back down again. I think that this is going to be the story of this expansion, however long it lasts, that we're going to see a fair amount of volatility until we hit some sort of a glide path. And right now you have that argument between, is the glide path going to be, you know, back where we were before, slow growth, low inflation, you know, the demographic.
Okay, traders, hello again. Bitcoin. If you can see, if you remember, all of you guys who copied my trade and follow my trade yesterday, we purchased Bitcoin at, as you can see, the price 32,748. Right now, it's time to place a stop on profit at 32,912. It will give us 0.5%. So first we'll do 32,912. Here is stop on profit, and I'll show you where we purchased. Just right here. Okay. So stay with me. We're already 0.5% in profit. So whatever happened, you will close this trade in profit. Okay? Okay. If you want to get the strategy, please go to company.co.uk and you can get the strategy and you will find out how we trade. Otherwise, you still can copy our trades. It's stream live. We stream live every day, Monday to Friday. So you don't have to worry about that you will miss some chance or opportunity to trade with us. Okay? I'll speak to you later, guys.
Repress equilibrium to a less repressed policy-wise good equilibrium. And that would be good. But if it turns out that the Fed is wrong, then the equilibrium ahead of us is not a good equilibrium. And that's something that's going to play out not in the next days and weeks, but in the next quarters, John.
Kathy, I want to give you the final word on what Mohammed just said. He referenced Bill Dudley. Take a listen to what Bill had to say.
They basically said that we're not going to even begin to raise short-term rates until three conditions are met. The economy has to be, at their view, of full employment. We have to hit 2% inflation, and they have to be confident that inflation is going to go above 2% in the future. That's very, very late to actually begin the tightening process in terms of lifting off in terms of short-term interest rates. Before, they used to try to hit, they lifted off early with the idea of hitting 2% inflation, full employment, and a neutral federal funds rate all at the same time. We're not going to do that this time.
Final word, Kathy Jones, on Bill's point. Mohammed referenced it, the idea that when they do lift off, that trajectory, that path will not be as shallow as what we saw in the previous cycle.
Yeah, I think that that's the hope for the Fed, right? They don't want to get stuck at very low levels of activity. So maybe they're falling behind and they believe they can catch up. That's preferable to, missing the target for 15 years in terms of inflation and unemployment.
Kathy Jones, sticking with us alongside Mohammed Al-Erian on this market. What a fascinating week this has been in this bond market. Some breaking news in the last 10 minutes. Let's get you up to speed. Here's Ritika Gupta.
Yeah, thanks, John. That breaking news that the U.S. is blacklisting Chinese companies. That was expected, but we are now getting the names of those companies, particularly coming from some of the tech space. This is over alleged human rights abuses. It prohibits U.S. firms from doing business with those companies without a license. So again, U.S. blacklisting 34 entities from China, Russia, and Iran, blacklisting those companies. John.
Ritika, thank you. A developing story that we'll keep on top of for you. This equity market doing better this Friday. With your movers, here's Kelly Greifeld.
Well, John, let's start with the automakers because they're pushing this higher this morning, and General Motors is leading the way. Wedbush initiated coverage with a buy this morning, citing General Motors' electric vehicle push. EV names Nikola and Fisker are also in the green, as is Ford. And let's look at the vaccine makers as well because they're rising before the bell. Pfizer said yesterday that a booster for its COVID-19 vaccine is needed. Regulators aren't as sure, but still that's giving a lift to BioNTech. And shares of Moderna and Novavax are also set to open green, John.
Kelly, thank you. On top of the movers through the opening bell as we count you down. We'll head down to Washington, D.C. next and catch up with our Washington correspondent, Anne-Marie Hordern, and get some final thoughts from Mohammed Al-Erian and Kathy Jones of Schwab. 14 minutes away in this market. We're 14 minutes away from the opening bell, and your market looks like this, 43.30 on the S&P. This is Bloomberg.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a kind of primal scream to try and redress the balance of power between workers and firms. When the balance of power sits with firms, firms can put in occupational license, decades of poor wage growth. The question is, does it have any teeth? Is it merely wishful thinking?
President Biden delivering a sweeping executive order promoting competition across a range of industries. The White House writing the following quote: in over 75% of U.S. industries, a smaller number of large companies now control more of the business than they did 20 years ago. They're worried about higher prices and lower wages. For more, let's bring in Bloomberg's Anne-Marie Hordern from D.C. And Anne-Marie, you know the question, does it have any teeth?
Yeah, well, that's what everyone's really digging through this morning. But the Biden administration certainly thinks they can get things done with this executive order. And they're being pretty directive in terms of what they think these regulators should do. And as you mentioned, John, it's really a plethora of industries: agricultural, tech, healthcare, pharmaceuticals, banking. They really are not holding anything back. What will be the next step is to what exactly happens with these regulators, how it is written and how is it implemented. But clearly some of them could take legal challenges. That remains to be seen which ones. Of course, it depends on how it's drafted and legislative. But some of it, Jonathan, has already been done during the Obama administration. Things like net neutrality, things with the airlines and baggage fees, that's already been done. Things I think that are going to be a little bit harder to see how exactly they go forward is when you look at the things like in big tech and the pharmaceutical space.
Anne-Marie Hordern, down in Washington, D.C., our Washington correspondent. Anne-Marie, it's good to see you. Thank you. For a final thought, Kathy Jones of Charles Schwab and Mohammed Al-Erin of Queen's College, Cambridge, back with us. Mohammed, you know how the approach to policy works as a market participant. You somehow have to divorce your emotions about what you would like to see from what they will do, and then you have to ask if they'll be successful. Do you think this administration will be successful to develop some kind of policy, a set of policies that leads to higher wages?
I do, John. I think that if you look at the measures together, as opposed to each one on a standalone basis, the direction of travel is very clear, which is shifting power back from capital back to labor. And that is what's going on. And various tools are being used, fiscal policies being used, regulatory policies being used to that extent. So the direction of travel is clear. It's not an instantaneous arrival at the destination, but we will get there step by step over the life of this administration.
And Kathy, this question that Mohammed's answering right now is really important for bond investors. This transition away from power, from maybe capital over to labor, if you think they're going to be successful in doing so, what does that mean for a market participant, for a bond investor?
Yeah, I would agree with Mohammed. I think that we are on the cusp of that change, largely due to the fact that we have a very tight labor market right now. So the demographics are showing us that some of this needs to go to labor. I think for a bond investor, that means you look for higher real yields that have been negative in real terms for a long time. I think over the next couple of years, you would look for higher real yields to match up with higher growth.
Kathy, I've put you on the spot before and asked you to play the piano live on TV and radio. I'm not going to do that right now. I'm going to put Mohammed on the spot and allow our audience to observe how an economist answers a question about sport and a game on Sunday, England versus Italy. Mohammed, you've got to pick a side.
I think Italy will end up winning, much to the sadness of a whole nation that has bought into an English miracle. Having said that, things have been incredibly aligned for England. So I am looking forward to this game, incredibly looking forward. And next time I'd rather play the piano for you than answer that question, John.
On the one hand this, on the other hand that. Mohammed, I expect
like an
nothing
economist.
less. Thank you very much.
A good economist.
Mohammed Al-Erin, a phenomenal economist. Thank you, alongside Kathy Jones. Guys, enjoyed catching up. Coming up, the morning calls, and later, Wall Street remaining divided over the fate of the reflation trade. That conversation with BlackRock's Jean Bavin and JP Morgan's Phil Guarco. 7 minutes away from the cash open this Friday, racing towards the weekend. 43.29 on the S&P, up 16 points. We advanced 0.4%. This is Bloomberg. 5 minutes away from the opening bell here from New York City. Good morning to you. Equity futures shaping up as follows on the S&P, advancing 18. We're up about 0.4% on the S&P. Outperformance on a Russell this morning, up by 1.24% for small caps, underperformance for big tech. The Nasdaq 100 negative, about 0.1%. That's the price action. Here are the morning calls. Evercore upgrading Norfolk Southern to outperform, citing a favourable valuation and overstated regulatory concerns. Your second call from Wedbush initiating coverage on General Motors with an outperform, seeing upside stemming from GM's accelerated push into EVs. And finally, Barclays raising its price target on American Express to 155, expecting earnings to reveal improving credit metrics. That stock is up by 1.35%. They are the calls. Up next, Wall Street remaining divided over the fate of the reflation trade. That conversation next with BlackRock's Jean Balvin and JP Morgan's Phil Guarco. From New York City, your cash open just around the corner. This is Bloomberg.
G7 today they need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From the Russell, from the small caps, up by a little more than 1%. That is your opening bout. Switch up the board. Your bond market shaping up as follows. And this is the epicenter for it all. Yields lower for 8 straight sessions into Friday, putting a little bit of stress on the small caps and empowering the big cap tech players. This morning, yields are higher by 5 basis points to 134.27, and that delivers some gains into the small caps. You get the picture? We're all rate strategists now, apparently. Outside of the bond market, into FX, 118.67, a euro that's stronger. Crude heading north, up by 1.5% to $74 and around about 6 cents. That's the cross-asset price action at the market desk with your movers. Back with us is Katie Greifeld.
Well, John, let's check back in with General Motors because it is rallying out of the gates after that outperform rating from Wedbush. It's up about 4.5% already this morning. You also have American Airlines and Carnival gaining ground after getting hammered for most of this week, rallying on this Friday. And Freeport-McMoRan, it's higher after Jeffrey said sentiment towards miners should rebound by year end. But John, even with travel and energy rebounding, it was a rough week for the reflation trade. Small caps bore the brunt of that, leading weekly losses among the major indexes, while the NASDAQ composite, that was your relative outperformer. And John, if you look across the asset classes, it feels like maybe the transitory inflation narrative is starting to stick. You had 10-year Treasury yields falling for a second week. Bonds have rallied 7 of the last 8 weeks. Gold managed a gain, but crude oil, it's set to fall after 6 straight weeks of gains. And finally, John, corn and wheat, they're having their worst weeks since May.
Katie, I'm with you. This all comes from the bond market, and you see this rolling correction in the words of Morgan Stanley. It started with 10s. We're at 134 right now. We peaked at the end of March, at the end of the first quarter. I sound like a broken record. I repeat this almost every single day. Break-evens, implied inflation expectations from the bond market, if you want to call it that, they topped in May. And this rolled over to the banks. Start of June. Since then, in the last month, the S&P 500 bank sector is down about 11%. Take your pick. Take Citi, coming into Friday, down by 16% off the highs of last June. What outperforms today? It's the financials, up by 1.5%. The why? It comes from the bond market. Yields are higher, which is why I keep asking this question going into next week. What matters? The earnings, as JP Morgan kicks things off, the commentary that you'll get in the calls, or where you think this 10-year yield's going for the next couple of quarters. We caught up with Jan Hancock's Emily Rowland, bracing for a volatile second half for stocks. Take a listen.
There's important changes happening under the surface that require a change in positioning. But we are embracing quality growth, which is an area of the market, as you know, that we have been overweight over the last 12 months. Everything was up, regardless of industry standing, regardless of the ability to outperform the competition. Over the next 12 months, it's like the Olympics, right? Things get a lot harder.
Jean Bavin of BlackRock joins us now. And Jean, I think you've asked a simple, but possibly the most important question right now. What comes next? What lies beyond this reopening, this powerful restart? Because we've had it. This is it. And we've had the market move. It started at the start of November. There was aggressive repricing of growth expectations in the first quarter of this year. That was captured in the bond market, in real yields. And then we reset. What does come next, Jean?
Great to see you, John. Thanks for having me. I think, yeah, the key question is, the restart is real. It's powerful. We've been going through this now, and now we're starting to look beyond the restart. We've been starting for the last few weeks. Market has been focusing on this, and I think the reality is we're grappling with a potentially unusually wide range of potential outcomes looking beyond the next few years. And I think this is unusual. We haven't seen that for the last 10, 15 years. I mean, people have been contemplating maybe a roaring 20s type scenario where we have a breakout of growth. We've been thinking about inflation maybe getting out of control, and now we're back to worries of disinflation. So this is unusually wide range. I don't think the data flow we've seen confirms any of these scenarios yet, but the market is primed to see the data flow and overreact in one direction or the other. So I guess our advice in this environment is take a step back, try to have a view a bit longer term. Restart is real. We're probably going back to pre-COVID trend growth. It's not a bad outcome. And around that, try to fade the overreaction we're seeing on both sides.
John, I'm going to pick up on that theme and bring in Phil Guarco from JP Morgan on that. Phil, the return to trend growth. And then it makes me ask the question about the shape of this cycle, because so many people are conditioned by what happened in the last decade. It was slow, steady, long, and a chart of the S&P 500 was bottom left to top right without much interruption. Is it any different this time around?
Well, I think when it comes to trend growth, we're still thinking that it's going to go a little bit higher temporarily. I think, though, when it comes to the bond markets over the last...
Okay, traders, let's move to stop and profit orders. For Bitcoin, I'm going to move stop and profit to 33,076. It will give us 1%, just right here. So if you follow trade and you're already in profit, 33,076. Okay, we'll adjust right now. And also I'm going to change stop on profit for euro. Okay, so we move Bitcoin, and for euro I'm going to place stop on profit to 118.59.6. Okay, 118.59.6. 2,500 pounds in profit, guys. Good trade. Well done, all of you guys who didn't sleep and decided to trade euro. I'll speak to you later, guys.
Decent for risk assets. You don't expect that this time around?
Yeah, no, thanks for an important clarification here. We might be going back to trend growth, but what we're looking ahead of us is, if there's a lot of range of outcome, but one that is not on the table, that clearly not on the table in our view, is a repeat of the last 10 years. That's clearly not in the card. There are a couple of reasons. First, the policy response we've got over the last 18 months or about is at the scale that is completely of a different magnitude than what we've seen in the GFC. So the policy impulse is very different. It's much more stronger on the back of a shock that ultimately on the economic side of it is a fraction of what the GFC, the global financial crisis, was. So we're saying as a result of this, a very different dynamic. So we're not in a world where we're going to see the weakest recovery on record, which was the last 10 years. Where inflation undershot systematically expectations. I think we're on the other side of this now. We're going to see maybe growth that is solid but at potential, and then stimulus that is going to continue to go through the system that's going to bring inflation to a slightly higher regime. And in that environment, difficult to see both bonds and equity going to a decade-long bull market. So we don't expect that to happen. We think it's constructive for risk for the next couple of years. That's a new nominal team we have, but it's not one where we'll see like 10 years of bull outcome for both equity and bonds.
Phil Guarco, your reaction to that?
Yeah, I would tend to agree, but I would reiterate, maybe thinking back to Reinhard Rogoff, who in their famous papers said that, increased debt loads at the national level, especially at the government level, mean lower growth. I think that's misunderstood in some ways. It's not just the growth in the national debt, but it's really how that could limit policy actions in the future. So I think, as Mr. Baran was saying, we've done, or the government and the Fed has done what they needed to do, but each time we do this in massive ways, we wind up having a little bit fewer bullets for the next time. And if we have fewer bullets for the next time, and it seems as though these shocks seem to be accelerating, maybe the method we get out of the next one, because there's always going to be a next one, we're not going to be as strong as we have been in the past.
We're getting into cycle calls here. And John, the call you're making that we don't expect another decade-long bull market in stocks and bonds, to your point, that's not going to be another issue for a couple of years. So I guess the question for me is today, if that's the cycle call, is it relevant to the call I make today as a market participant? Does that affect my investment decisions right now? Or is it something to worry about further down the road?
I think for now, and to the point that my colleague was mentioning, Mr. Guarco, the debt level is a big part of the story. I think that's why rates will not be able to go up materially over the next few years. That's why it's an environment we're going to see inflation creeping up to some extent, but rate remaining muted response. So real rate will be low. And for now, I think it means a pretty constructive environment for risk, something we've not really seen before. We're going to see some inflation coming through, but that won't be detrimental to equities in our view for now. And so I think the big call for now is, I guess, probably expect modest return expectation on a 5-year basis, but in the front-loaded and happening now. And I think as a result, time to take risk is probably now.
Jean Bavin of BlackRock, Phil Guarco of JP Morgan sticking with us. John, lightening up on US equities a little bit with the team at BlackRock. We'll touch on that in a moment. Looking ahead to next week, just stacked going into next week. At the market desk with your bank earnings next week is Katie Greifeld.
Well, John, we're definitely seeing a relief rally for the financials today as Treasury yields come off their lows. That is your top performing sector this morning ahead of second quarter earnings season, with the big banks kicking us off next week. But John, we'll see if earnings even matter for the financials, since bank stocks tend to track rates more than anything else. Even with record trading revenues in most cases, banks underperformed the broader market last quarter as Treasury yields peaked. And John, it's a tricky setup this earnings season. Second quarter trading revenues are seen falling by about $9 billion at the 5 biggest banks. That's a 28% drop. And you can largely blame that on base effects, really, just that 2020's trading revenues were so high. But in any case, it looks like the trend is breaking, John.
It has been a struggle for the big banks over the last month, at least in terms of the stock prices. Year to date, still pretty decent. That's for next week. Coming up next on this program, it's day one of the G20. Finance ministers and central bankers negotiating a new global tax rate in Venice. That conversation up next, and reaction from BlackRock as they turn neutral on US equities. That's next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to